Alrighty, so hopefully you should be very comfortable with the LC2A entry model where we wait for the fake break. Now, for those of you who can remember this lesson towards the end of the liquidity module in the technical analysis module, you may have realized that what we tried to say back here was that if there is no available liquidity in the leg to the left or available liquidity to the leg in the right, then very often our medium time frame POIs will fail. Okay, so what we've been doing with LC2A is waiting for that pullback inducement to be built, right? Waiting for the PBID, and we can do that on our lower time frame, right? So we have our medium time frame POI, and we just wait for that fake break to occur, get the liquidation, POI mitigation, and then hopefully we make tons of money, right? So as some of you have probably guessed, well, the other way in which we can now enter is with LC1, as we call it, and that is using leg inducement, okay? And that's really as simple as it is. So the first entry model you've looked, LC2A uses inducement in the pullback, so we only look at strong liquidations that form in the pullback. We don't look anywhere else. Now with LC1, we are allowed to look at that medium time frame leg to the left, and we are trying to identify available strong liquidity points within that leg, right? So the lows that broke the high, we use those liquidation points for our entry. Okay, so hopefully now in your mind, it's all starting to come together, right? So imagine that, well, let me put it this way. Once you get your POI mitigation, that's always going to be step one. We know that by now. You're probably sick to death of hearing me say it. We need to see that first before we can even be thinking about an entry. We get our medium time frame POI mitigation, we drop down to our lower time frame, okay? The way I want your brain to work is I want you to first look for LC2A every time, right? So once we get step one, you now want to ask yourself, okay, where is the strong liquidity? Have we had a strong liquidation? And I want you to just always look for LC2A in the pullback, right? So from the top of the pullback down, try and look to see, has there been a fake break liquidation? So obviously in a bullish scenario, have there been any lows within this pullback that have broken a high? Well, did this low break a high? No. Did this low break a high? No. Did this low break a high? Well, no, obviously not at that point, right? So there's been no fake break liquidation. Now, the reason why I'm telling you to look for that first is because it's the easier entry model to master. It's a lot less aggressive than LC1. So I basically view LC1 as like a bonus entry model. I much prefer LC2A. That's what I'm focusing on. LC1 is more aggressive, and it requires more experience to master it. So in the following lessons, I'm going to go into a lot more depth of when you should think about using LC1, because I personally only use it in a lot more rare circumstances. Okay, I'm a lot more strict of when I will even consider using LC1 because it's a much more aggressive entry model. So I do want to get that out of the way first. Now, assuming this is a scenario in which you want to use it, you will learn that in the future lessons upcoming, but let's just for now assume that this is a good time to use it. Let's talk through how we'll do that. So we've looked first in the pullback and we can't find any strong liquidation, okay? Now, assuming this is a scenario in which you're happy to use LC1, well, we're going to look for a sweep of lid. Where do we look? Well, we look in the medium time frame leg to the left. Okay, so that's that M15 leg, or like your 1 hour leg, depending on what your medium time frame is. And this is when we can then look for any strong lows within the leg. So literally just looking for where there's like a pullback and a low. Sometimes there's going to be a lot, right? Any of these lows, we can use that as available strong liquidity points, right? If price hasn't traded through. So once we get our POI mitigation, we now know there's no strong liquidation here. We're looking for a strong liquidation in the leg. Now, obviously this is a simple scenario because there's only one low, but very often you're going to get multiple lows like this, right? So once we get a POI mitigation here, you go, well, what low do we take? Because technically all of these are strong liquidations. Well, we don't need to draw all of them on. We're just going to go and find the nearest one to the POI, right? We look left and just find the nearest one. Okay, boom, there's our liquidation of that lid to the left, okay? And now we have it. So a key point about this, okay, is at least at the time of recording, for me, it's valid to use lower time frame lid. Okay, so we look for lid in the medium time frame leg. We're looking at over here, right? But we drop down to our lower time frame. So I'll go down to the M5. So I'll look at this area on the M5 and I'll look for any M5 lows that are in this medium time frame leg, if that makes sense. okay? So once I get my M15, my medium time frame POI mitigation, I'll look left, and if there's like an M5 structural low here, I can use that, right? That's my liquidation, and then I take the entry with the buy stop above the liquidation candle, okay? So this is quite aggressive because I would say in 90% of occasions, roughly, when you get your POI mitigation, if you start looking left on your lower time frame for lid, you're going to find it. There's almost always going to be a lower time frame low here. So which means that you're pretty much always going to get an entry if you use lower time frame lid, and you're using this for every scenario, which is why I'm saying this is a lot more aggressive, and I only use this in very, very specific scenarios, which again we'll get into in the next lesson. So I'm just trying to make it clear that this is a very aggressive entry model. So if you don't have the experience of when to use this, you can get yourself in a lot of trouble. Okay, so you have been warned. So what you can do is, instead of using lower time frame lid like I do, you may want to decide that you only use medium time frame lid. Okay, because in theory that should be higher probability than using lower time frame lid. So what do I mean? Well, when you get your POI mitigation and you look left for any lows here, any strong lows, it must be visible on your medium time frame. So for me, that means I would need to see an M15 low here. Okay, because sometimes what you'll get is you'll just get like one straight line and there isn't a medium time frame low, but when you drop down to the lower time frame, there is one. So if you want kind of stricter rules and let's say a higher strike rate, you may want to only put in your plan that it must be medium time frame lid. It must be visible on your medium time frame. Okay, so that's why I put in brackets, have a rule here where you need to decide whether you're happy to use lower time frame or it must only be your medium time frame lid, okay? In that medium time frame leg to the left. So POI mitigation on a medium time frame. If there's nothing built here to the right, so there's no LC2A, there's no fake break, then if it's a scenario in which you're happy to use LC1, then I'll look for a strong liquidation to the left, and then I'll take the entry. Of course, as well, only if it meets your validation rules. So you guys should know that. Go back into the LC2A module if you don't. Okay, we cover the two methods in there, the PBL method or the early entry method, right? So once we get a POI mitigation, we've identified a strong liquidation of lid to the left. Obviously, if the PBL has been mitigated and you use that method, then it's not valid. You would need to see either more lid down here get taken, or you would need to see a fake break built. Or of course, if it already gave an early entry, if you use that method instead, then it won't be valid. Okay, so make sure you understand what those two methods are. They're covered in the LC2A module, and just pick one, right, if you want to use them. And it's the same rules. Just place your buy stop order above the candle until you get tagged in, right? So very simply, this is LC2A. We look for a strong liquidation in the pullback. Happy for that to be on a lower time frame for me. LC1 is using lid to the left. Again, I'm happy for it to be a lower time frame low if it's a bullish scenario. But some of you, and if you're starting out, I'd recommend just using a rule that it must be visible on your medium time frame too, and that in theory should be higher probability. Okay? Because LC1 is much, much more aggressive. So you're going to learn in the following lessons of when I consider using it, because it's in rare circumstances. This is like a bonus entry model for me. It's not my main thing I'm looking at, okay? So bearish scenario, same thing, right? Medium time frame, break of structure to the downside. We're looking for shorts from our POI. So step one is always wait for your POI mitigation. Okay, step two, has there been a strong liquidation in the pullback? Or have any of these highs broken lows to the left? Did this high break any structure here? No, right? It's a weak high, not a strong liquidation. Did this high break this low? No, not a strong liquidation. And at this point, this high obviously hasn't broken anything when we're trying to enter. So if we're happy to use LC1, this is then when we can start hunting for relevant highs to the left. Okay, we have a high here. Assuming there's been no PBL or early entry invalidation, then we can take the entry. Okay, as simple as that. So literally just looking for strong highs in the leg to the left, or strong lows in the leg to the left if we're looking for longs. Okay, let's dive into some real examples. Alrighty, so you've seen kind of the theory diagram of the entry model. So in this lesson, we're going to go through one example on the chart, but purely just to show you the exact mechanics of how we actually take the entry. Okay, but then all of the remaining lessons in this module is where we're going to spend a lot of time focusing more on when you should be taking this entry model. Because the LC entry models in general, so LC1 and LC2A, they are based on the exact same entry models we were using before, right? Like LQEM1 or LQEM2A. It's exactly the same rules, waiting for the same liquidations in the exact same areas, but we are just doing 2 steps less. With the new approach with LC, we are not waiting for the PBL to fail, and we are not waiting for a bullish change of character, okay? We are simply entering here rather than here. So everything up until this point is all the same like before. It's nothing new, exact same with LC2A. It's all the same, we are just getting in slightly earlier. We are not waiting for the PBL fail and chalk, okay? So, less confirmation makes it in theory a bit more aggressive, okay? But we have found that overall it's far more effective for your results. The point I'm trying to get clear and across to you is that knowing when to use them is super, super key, even more key than before, okay? And that comes in with your medium time frame narrative building and medium time frame POI selection, which is why, again, the rest of the lessons after this are going to be focused around that, okay? So, not going to talk much about the medium time frame idea. We'll actually come back to this example in a later lesson when we talk more about the narrative building of this particular trade and the POI selection, etc. But essentially, we have bearish M15 internal structure here. The M15 is going to be my medium time frame, okay? And we're just going to be looking for shorts playing a continuation of this bearish M15 internal structure, okay? That's as much as we need to talk about that for now, because I just want us to focus specifically on the exact details of how you enter the market. So in terms of POIs, this one, the POIs, if I just kind of look at this leg, right, we're going to be looking for something in this leg to enter on. It's kind of just a bit corrective price action and then we go. So the POIs aren't super clear, but this is how I had it drawn on my actual pre-session analysis, which you can double check in the Discord if you don't believe me. This being the primary POI that I'm interested in, it's at the extreme of the move. So this is what I would classify kind of as the unmitigated extreme. Yes, it's not the clearest the way it formed. It's a little bit corrective, which is why I've just taken the larger buy to sell, okay, just to clean things up a little bit. Now, yes, technically, I know some of you be thinking, well, Matt, isn't this a mitigation here and then a move down? Yeah, it kind of is, right? It's not ideal, but I just view this essentially as efficient price action with prices trickling down before we came. If we had price action that was like this, a clear pullback, a clear breakdown, or pull back into it like that, and then led to that move, then yes, that would be a much clearer mitigation. But in my experience, and as you guys will know who are more experienced, a lot of the times these POIs will still hold, price will come in and go like that, so I'll still keep an eye on it, okay? But what I also did is I also drew another POI on this clearer one here, right? Where we do clearly have that thrust candle that closes below the low, draw like that, that led to the move. So these are both well priced, they're at the top of this internal range. I'm happy to look for an entry model from either of them, but obviously the higher we push up into this POI, the better. So yeah, not the clearest, nicest, most textbook, perfect formation of how a POI likes to form, right? This is nice and clear like this, nice big candle, but for me, this is valid. So I did just want to cover that because I know I'll probably get a few questions and concerns around that. So we'll revisit the whole medium time frame narrative with this in a future lesson, but essentially we're just looking for shorts from either of these general areas to look for the continuation of the move, okay? So lower time frame for me is going to be the M5 here. So as you guys have learned so far with LC2A, once we get that clear pullback to our medium time frame POI, right, what would we wait for LC2A? We would look to see, well, step one, we have our POI mitigation, tick in the box. Step two, do we have a strong liquidation in the pullback, right? So this is the pullback here, right? The start of the pullback. Do we have any strong liquidations? Well, what's the strong liquidation? We need to see a strong high get taken out. So do we have any strong highs here? Well, what is the definition of a strong high? A strong high is a high that has broken a low to the left, right? Not looking at internals, we're looking at, did this high break this low to the left? No, right? This high clearly didn't do that. Did this high break anything to the left? No. We just have bullish fractal structure moving to the upside. None of these highs broke that low. This high did not break this low. So there is no strong liquidation here. There's no fake break, okay? You need to be very, very comfortable with that. So if you're waiting for LC2A, what would you need to see? You would need to see price pull back to form a high. Price would then come up and take that high. But obviously this high has not broken the fractal low that's down here. So this here would not be a strong liquidation. But the reason why we'd want to pull back here is so then now if we get a break of that low, right? So that's a bearish change of character on the M5, that would give us our strong high, right? So then if that happens, we would then use that as our potential fake break and we would look for a liquidation of that high, right? For price to take that out we'd still want to see the POI being respected. And then if we get our, if it tags us in with the candle breaking the previous candle's low, that would be our entry. So this you need to be very, very comfortable with. This is the fake break entry, okay, where price comes into our POI. We wait for a high to break a low, because that means that this is now a strong high, and then we wait for that high to get liquidated. Okay, we wait for a bearish change of character, and then we look for the extreme high that caused a change of character to get liquidated. So that's what you can wait for. Okay, now, if you want to introduce this additional entry model, you do not have to, but if you do want to, whilst you're waiting for a fake break to form in the pullback, right? When you're waiting for LC2A to form, we can also now use liquidity in the leg to the left, which is what we call LID. Leg inducement is what that acronym stands for, okay? If you want to use this is where we can look, again, we keep saying it, we can look for strong liquidity in the leg to the left. Now, I'm going to keep repeating this. There is only a few specific scenarios really in which you should ever be considering using this entry model and saying to yourself that, yes, I do want to look for LID to the left. And that is, again, what the rest of this module is going to be focused on, because it's very, very important that you are not using this entry model every single time you come to your desk and every session you're trading. Okay? This entry model is like a little bonus entry model that you should only be thinking about using in reasonably rare circumstances. So a lot of the times, you'll simply just be waiting for LC2A. You'll be waiting for strong liquidations in the pullback. That's what you want to be focusing on 70 to 80% of the time, maybe even more. And some of you may only want to trade that, okay? Because using liquidity to the left, it's going to almost always be there. If you're using lower time frame LID, right, it's going to be there almost every time you're looking to trade a POI, which is going to mean there's going to be entries all the time. There's going to be a lot of low probable trades, okay? So I want to really, really make that clear that you have to be very, very disciplined, and I will say experienced, to know when to use this entry model, because it is far more aggressive, okay? Because when you come down and you go, right, I've got my MTF, my medium time frame POI mitigation, okay? I want to wait for a fake break which hasn't occurred yet. Okay, let me just see, is there any LID to the left? Can I get involved? And there's almost always going to be LID. So that's why you have to be even more selective of when you're going to use this, okay? So what is valid as LID, okay? Some of you who've been here a while, you should definitely know what LID is. For those of you who don't, LID is any strong liquidity that is in this medium time frame leg to the left, okay? So this is LID, anything within this red circle, because that is basically what we refer to as the leg. This is the medium time frame leg, okay? So if I look at, use your medium time frame to kind of help you if you find that a bit confusing sometimes. This is a bit of a clearer example because we have nice, clear, right, trending price action. But sometimes it can be a little bit more messy. But basically, if you look at your medium time frame and you see that this is the clear leg down, right? And then this is the medium time frame pullback. This is where the PBID is going to be, your pullback inducement. That is where we look for the fake break to occur. This is where we look for the LID, okay? The leg inducement. So revisit the liquidity module if that's not clear. I can't really make it any clearer than that. This is LID. This is pullback inducement, okay? So if we're looking at this entry model, what counts as valid LID? Like I said, it must be in this leg, but what is strong liquidity in that leg? Well, it's any structural high, okay? So for me, for a definition of a structural high, see here how we have a fractal pullback? This high then broke the low. That counts as a structural high, right? Because there will be induced liquidity behind that high, right? That high is a structural high. Therefore, we assume there is strong liquidity behind this high because it broke structure. Okay, so if I bring price back a little bit, say to here, at this point, so I'm not telling you that you should trade the liquidations of this. Right now, I'm just going through what is the minimum definition of what LID is. LID is leg inducement. So so if we're bearish, it's any structural high in the leg. That is technically LID. Okay, it doesn't mean you should trade it. It's just understanding that that is what LID is. Okay, so let me draw on every single valid piece of LID on the M5. This is a structural high. Okay, so at a minimum, we can say there is strong liquidity behind this high because it's a high that broke structure and price has not yet traded past it. So it's kind of what we call available liquidity. There will be available buy-side liquidity above this high because it's a high that broke structure. Okay, so anyone, there'll be people who are short and they'll have their stop losses behind the structural high because it's a structural point in the market. So if you're short and you have a stop loss, your stop loss is a buy order, right? Because if you get stopped out, you need to buy your short position back from the market. So we know that there's going to be buy side liquidity for that way. There'll also be people looking to buy the breakout of this high, right? So that's obviously going to induce buy side liquidity behind that high, right? This is all covered in the liquidity module, so make sure you recap that if this is confusing to you, right? So we're just simply looking for where is there available buy side liquidity in only this leg to the left, leg inducement, right? So we say it's available liquidity because price has not yet taken liquidity behind that high. So at this point, there's lid there. This is the next structural high here, right? This is a high that broke the low, okay? I don't know if they're perfect equal highs. Yeah, they're perfect equal highs. So that's how I would draw the lid there, okay? This is another high that price has not traded past since. That's valid lid, right? For instance, whoops, this here, this high is not lid. Okay, why is this not lid? Yes, it is a structural high within the leg, but price, if I zoom in, has already traded behind it, right? We've already taken and used the liquidity behind this high. So this is not available strong liquidity because it's already been used. It's already been swept. The orders have already been liquidated and it's already led to a new move. So that's why for lid, we're only looking at these highs that have not yet been liquidated, okay? So again, following that logic, this is the next high with available strong liquidity behind it. This high too. So you can see now already, if you are using lower time frame lid as potential strong liquidation points to use for an entry, very often there's going to be tons of them, which means that if you trade every liquidation of every single one of these highs, you're going to get in trouble if you don't use it in the right area, right? Okay, so they are technically all the areas. I mean, you do technically have this high within here, but if price liquidates that high, right, at that point, what's going to happen? The POI is going to have failed, therefore it's not valid, right? The POI needs to be respected. So these are all potential, on paper, these are potential, well, let's just reiterate. These are all valid, what we call leg inducement, right? Because these are liquidity points in the leg. So obviously, we're not going to use any of these until we actually get our POI mitigation. Now, the textbook and high probable entries you will see with this entry model are where the lid is basically right within or just before the POI. Like here is just before the POI, okay? They are going to be your textbook entries, not using like stuff all the way down here, okay? But I just want to go over what is the most, what is what is valid. And technically all of these are lid. Okay, it's a horrible acronym, but yeah. So let's play this forward, right? Now bring it back one candle, we get our POI mitigation, okay? And let's say that this is a scenario in which you believe is valid for you to look to use lid, okay? So step one, POI mitigation. Do we have a strong liquidation? Well, we already know that we didn't have the fake break in the pullback. So this is where we go, okay, I want to use some lid in the leg to the left. Now, technically we have lid all the way down here, but not really too near I want to use. But even if you did, the way you can define it is the exact same way we did in LC2A, which is the PBL still active, right? And then you can look at your PBL down here. Now, if you take the sell to buy, you could say, okay, well, we've had that range. We could say we've had a pullback, a mitigation, and we've pushed up higher. And therefore, this is no longer valid for you. You wouldn't use it. If you're a bit more refined, then you could go, yeah, it is valid, okay? But this one isn't really that relevant anyway. It doesn't matter. Why? Because we've got one here. So you're always going to use the nearest one anyway. So you don't even really need to debate too much about that. And then this one, we can still use this as the PBL, right? This is the clear demand that led to the liquidation of that high, okay? So the problem / question of how do I know if strong liquidity is too far away for my POI to be relevant? Remember, that's where we use the PBL method. It's not the most perfect solution, but it's one mechanical solution in which you can use. And if this PBL is still active, right, if it hasn't had a mitigation that then led to the break, then you can use it as a potential entry, right? You can say that this liquidation here is still relevant. So we now have our POI mitigation, step one. Step two, do we have a strong liquidation? Well, yes, we have a liquidation of this lower time frame lid, right, in the leg to the left. So that's valid. So therefore, if you want to trade this, it's the exact same rules as LC2A, right? That's your liquidation candle. You put your sell stop order below the low, whatever entry buffer you're using, and then whatever stop loss buffer you're using. Let's just say we use 2 pips for now. And that would be how you would size the entry. Now, whether you should take this entry or not, again, is going to depend on your medium time frame narrative, whether you're happy with the risk reward, all of those things. I'm not getting into that for now. This is purely just the mechanics of how you would enter if you know that you want to enter here. Okay, POI mitigation. Step 1, strong liquidation with the lid to the left. Okay, this is where you would then place your entry order on this candle. Next candle breaks that candle's high. So the very, very second that the high of your entry candle is broken, you would cancel your order, right? And you would wait for this new candle to close. Is this POI still being respected? Yes, therefore wait for the candle to closure if you want to take the trade, if the risk reward still makes sense, etc., etc. And then size it up. I'm not going to keep doing it perfectly to do it. You guys should know basically how to do that. Price pushes up higher again, cancel your order, wait for the candle to closure, resize. It's still valid because the POI is still being respected. You would enter on here, okay? Inside bar, so now you do nothing. You either wait for your order to get tagged in or you wait for the candle high to break and then you would cancel your order, okay? So with inside bars, we do nothing. Another inside bar, so we do nothing. And as long as obviously this is still within your session, then you can leave your order on. Okay, now we push up higher. Now we cancel the order, okay? Now this POI, this initial one we're looking at, this one is now finished, so we delete it. Okay, the trade idea from that lower POI here is gone. But we're now in our higher POI, which is nice. It's a higher probable POI, okay? So same thing, POI mitigation. Do we have a fake break liquidation in the pullback? No, right? This high did not break any structure. So you would need to see what? You would need to see this high break that low. That would give us our bearish M5 chalk. You would then look for a liquidation of that high, right? And then you would take the entry if you wanted the fake break. Okay, but now what do we have? Now we have a liquidation of this high to the left, right? So we can always use the most, the nearest liquidation. Yes, there are valid ones down here, but they're not relevant anymore, right? We may as well always use the nearest liquidation here. Okay, and obviously we've taken even further highs here, right, to the left. You don't have to have them all drawn on as long as you've got at least one that's relevant. That's all that matters. So again, step 1, POI mitigation. Step 2, look left. Valid lid liquidation. Okay, so we can set our entry order below the low of that candle. Okay, I'm not going to size it up perfectly, but you guys get the idea. Inside bar, so we do nothing, we wait. Next candle pushes up higher, so we would cancel our order. Is the POI still being respected? Yes, we are still within the POI, so the trade idea is still valid. Okay, sell stop below the low. And then again, size up your trade. You still need to ask yourself the question, does the risk reward make sense? However far you think price can go, etc., etc. And that would be how you size the trade up. So yeah, it can seem a bit confusing. I've got all of these highs drawn on, but when I'm doing this like in a live market or back testing, I don't need to draw on every single high, right? I'm just looking at, have we taken, an obvious, have we taken lid to the left? Is the PBL still active? Yes. This is the PBL that took out that high. All right, price has clearly not come into it. I made a clear new higher high. I've also taken more liquidity here anyway, so that would still be a valid trade, okay? And then inside bar do nothing, then you're tagged in, and then you whatever your trade management is, okay? So that might seem a bit of a complicated way to explain this entry model because in reality it's very, very simple. We are literally just looking for our POI mitigation. If there's no fake break built to the right, we can just look for a liquidation of a high to the left. Okay, that is it in a nutshell. But I know that there could just be some questions around exactly what is valid and what isn't. So I kind of wanted to go over this almost painstakingly slow to really make it clear. Again, I'm going to keep reiterating there are only very specific scenarios in which you should even be thinking about using the entry model and even thinking about using lid to left because this is extremely aggressive. Okay, so I would say you're not comfortable with identifying LC2A, you're not really consistent with executing that, you're not consistent with your results, you're inexperienced with building the medium time frame POI narrative, do not touch this entry model because I think you will end up burning your fingers, right? This is a lot more aggressive, but it can be effective when you know when to use it in the right times, which we're going to try and do my best to teach you in the following lessons, okay? But again, the dynamics are POI mitigation. I myself personally are going to prefer like waiting for that fake break here, right? Ideally, that's what I want to see. I want to see a nice fake break, a high that breaks a low. We see that chalk here. We see that high get liquidated. That's my favorite entry model. I want to get in here, okay? Sometimes that isn't going to happen, and this is where we can use lid to the left. Now, a great thing about this one, which was even better, is if you look on the M15, what do we have? That high that we used is valid M15 lid, right? Your medium time frame lid. So obviously, if it's visible on your medium time frame, that lid that we're using, in theory, that should be higher probability, right? Because time is power. The higher the time frame we go, the more significant it is. So again, we'll talk about this later in the module, but some of you may want to only use this entry model with medium time frame lid rather than using lower time frame lid. Okay, I haven't actually recorded the data on the difference between medium time frame and lower time frame lid. That might be something that could be a good idea for you to do, okay? Because you may want to be, until you're a bit more experienced, you might want to introduce more stricter rules to make it stricter and go, right, I'm only going to use medium time frame lid, right? But I mean, yeah, this would be valid medium time frame lid as well because we have a fractal pullback there. So that is a structural high on your M15. Okay, this candle failed to break the previous candle's low. There's your fractal pullback. That would also technically be medium time frame lid, right? Now, you also can use a little bit of common sense. There are going to be times where, you're not quite sure if you want to use, like we've got lid all the way down here. We get the initial mitigation here. We're coming up with a lot of momentum. You might be like, I'm not too keen to use, to get involved. You might want to exercise a little bit of patience / discretion and go, okay, yeah, I can recognize there's a valid maybe entry here, but I'm going to wait for a bit more. And then when you see, okay, we've taken clear medium time frame lid here, we've literally mitigated almost the extreme of this extreme POI. We've then seen price start to retrace. You go, do you know what? Okay, now I am happy to get involved because there's no real room for the LC2A to form at this point, right? Because if we got the bearish shock here, which we did, you would then be waiting for a liquidation of this high. And if price liquidates that high for the fake break liquidation, well, the POI has already failed and we're probably going higher at that point anyway. So do you know what I mean? There are some ways in which you can kind of use a little bit of extra patience and a little bit of extra discretion to go, do you know what? I'm not going to take the early LC1 entry. Oh, well, now we've literally mitigated the last level that needs to hold if this trade idea is going to continue. So therefore, now I'm willing to get involved with LC1. So do you know what I mean? By not blindly just taking every entry, but maybe sometimes wait, I don't really want to take LC1 here. I'm not too sure. Okay, now I've seen a lot more confidence to get involved. Now I'm going to get involved, right? So there are things you may want to use a little bit of judgment, use that 10 to 20% of discretion to add to your trading, as it makes sense to do. So this is a nice clean bit of price action, very obvious trade idea. And these are the types of times in which you want to take it, but I'll go into more detail, like I keep saying in the upcoming lessons of when you should consider it. I'll try to make it as mechanical as possible as I can for when you guys should be thinking about it. But I'm just very, very, very concerned. I mean, it's just part and parcel of what's going to happen. Inexperienced people, as you come through here, I get it. You're going to see a central model, and then you're just going to look to take trades, and you're going to be hitting them left, right, and center every session, every day, and you're going to burn your fingers. It's gonna damage your mental and financial capital at times when you're going to hit those inevitable periods of unnecessary drawdown with this. So use this entry model with caution. I'm going to have to just warn you as much as I can. Okay. Don't be just trading every single liquidation of every little lower time frame high in here, because you're going to have a difficult time if you do that. Okay, so yeah, we'll go into this in a lot more depth. We'll try and cover a lot of trade examples, and we'll combine it with the phases. But hopefully it makes sense as to how you actually, the mechanics of the entry model. There really should be minimal confusion for those of you who already understood liquidity entry model 1 and liquidity entry model 2A with the old style. What we are now doing with the LC style is exactly the same. The rules have not changed on how you identify liquidation or anything like that. We are simply just entering a little bit earlier, right? Rather than waiting for the PBL fail and choke, we're just getting in at this point rather than waiting for that. Okay, so all the rules are the same. The only difference here is I'm saying that you can use lower time frame lid, but obviously exercise that with caution because it is a lot more aggressive. So hopefully that's clear. It's all built on the same way as LC2A, except rather than waiting for a strong liquidation in the pullback, we can use those highs and lows to the left. But ideally, you want to be kind of focusing on the liquidity points in the leg that are very near or within the POI for the most part. Okay, it's obviously a little bit of discretionary of how near something is. And the PBL method is one way in which you can mechanically help with that. So watch the PBL common mistake video in the LC2A module again if you're unsure of that. But yeah, we'll go through more stuff. Hopefully that's kind of as clear as I can make it. So hopefully there's not too much confusion in this. And yeah, let's do it. Alrighty, so let's do another lesson based around the MTF phases, medium time frame phases. Gonna get sick of me saying it, but it is probably the most important part of being able to nail the strategy is really understanding the medium time frame phases, right? Because that is what helps us to use somewhat of a systematic framework to understand what is a high probable or medium to high probable area to enter the market, right? We build all of our trade ideas on our medium time frame, and those are the medium time frame POIs where we trade those ideas. Okay, so the medium time frame determines the direction in which we want to trade, and once we've identified that direction, we then look for the medium time frame POIs, these blue boxes, to then trade that idea. Right? Once price mitigates those medium time frame POIs, it's only then do we then drop down to the lower time frame to look for our entry models. Okay, so with this diagram, we're going to go through all of the sort of phases and the areas where these colored circles are. So like red, green, and orange, they are the areas in which we get a POI mitigation that I'm going to talk about. And of course, that's when you would then drop down to your lower time frame to then look for your entry model of choice. Okay. So obviously red being low probability, orange being medium, green being high, right? It's not an exact science, but it's the whole idea for this isn't to cover every single possible scenario that could arise in the market. The idea behind this is with, as we go through, you need to understand kind of the general logic of why we view something to be kind of medium, low, or high probability. And then with time, it will make sense in your head. No, I don't want to keep saying words. Let's just kind of dive into it and we'll go through it piece by piece. And yeah, just watch this as many times as you need. So really this kind of box up to the left-hand side. Now, if you can't see any of the text because it might be a bit too small on the video, I obviously will put a high quality screenshot of this exact chart beneath in the notes. So make sure you click into that and you can zoom in and it should be very, very clear. Okay, and I'll put the text below the video as well. So really first things first, I mean, this whole diagram, I primarily have made it for us to discuss when to use the LC1 entry model, right? Where we use lower time frame lid as a strong liquidation into our POI. The first thing to say really about that is when you are looking to trade in the market, I mean, around 80% of those scenarios, you should really be waiting for the LC2A entry model. Okay, that's kind of the way I approach it. The majority of the times, that's what I'm waiting for. I'm waiting for that fake break liquidation to form in the immediate price action, right within the POI. Those are how my textbook high probability positions look like. Okay, so that should be your main entry model. And then think of LC1 as like almost a little bit of a bonus. It's a little extra tool in your arsenal to pull out in specific scenarios to help you get involved where the LC2A entry model may not set up. Generally, when that happens, it's when we have a very tight and small MTF range, right? You guys who have experienced will know that. Sometimes we get these quite big, large swing ranges like this. So then when price pulls back, you get like multiple internal ranges. We get like a lot of structure, and then eventually we get that bearish IBOS. And it's like, if these ranges here are quite small, trying to shorten here, for example, this is kind of the perfect scenario of when I start to think about, yeah, it's okay to look for LC1 now, okay? So yeah, we're only really going to think about using LC1 when we're in those high probability, or at least the higher end of medium scenarios, okay? And really the thing that needs to be kind of the criteria every time is that it's a tight / small medium time frame range. Now, mechanically defining what is a tight or small medium time frame range is quite hard to do. That's something, again, you're going to have to use a little bit of discretion with and build experience with over time. But a bit of a tip that I could kind of think of is that when you get, say, like your mitigation, so imagine we're here, right, and price comes into your POI, and you go, right, I want to trade from this medium time frame POI here, right? And then you get the mitigation, so then you drop down to your lower time frame to look for an entry model. And then you ask yourself, well, is this small enough, this internal range here, this medium time frame internal range? You're asking yourself, is this small enough to look for an LC1, or is it too big? Well, this here is a bit of a tip you can say and go, right, well, when we get my mitigation and I drop down to my lower time frame, let's say that's the M5, can I see the M5 lid to the left here, okay? Because obviously what you're going to be using is, or maybe even this, or wherever it is, whatever lid you're using, kind of when you're looking for like the entry candle here, can you also see the lid that has been liquidated to the left without having to zoom out, right? Like the price action should almost be all together quite near. It's not an exact mechanical rule, but just to kind of give you a rough indication. Because sometimes what I think will happen is, say, like you're trading this POI up here, right? And it's quite a big, large swing range. We get our POI mitigation. Then you drop down to your lower time frame and you're looking for like a fake break liquidation here, and you're thinking, okay, can I use LC1? And then you look all the way to the left here. All right, I'm just gonna move these lines, and maybe you're using like a lower time frame high here, or maybe there's another one here or whatever, like whatever one was the nearest one to the POI mitigation. It's like, then you ask yourself, well, should I use LC1 here? My advice is no, because this is just way too far away. You're gonna have to zoom out if you're looking at your lower time frame to see both the entry candle and this. To have them both fitting on your screen, you probably have to scroll out quite a fair bit. So that's a good rule to kind of know, a good rule of thumb of like, yeah, this is probably too far away for it to be relevant for this LC1 entry model. Okay, generally you want it to be nice and tight like this. So if you can't see it like that, just wait for the fake break, right? So that's a kind of super crucial, really key part to that will help you to filter out the majority of times where you shouldn't be using LC1. This is kind of another thing, again, not a mechanical rule that it has to be this necessarily, but based on my testing and whatever, like these are the best times in order to not just take LC1, but all of the entry models in general, these are the best. It's the start of phase A and C. In more simple terms, always trading pro internal trend on your medium time frame and like the first initial phase of that. So when we get that first initial bullish IBOS here, this is that first initial phase C, right? Bang, bang, right? We want to get that initial phase, which I'll talk about in more depth in a minute. And then likewise, the start of phase A, here we get that initial bearish IBOS, shorts are now pro swing and pro internal. This is those high probable times to get involved. So what I would actually say to the majority of you, especially when first using this entry model, is actually, yeah, do make this a very strict rule and only consider it with phase A and C. And you may even want to do that for your entire plan, right, until you start to kind of get a bit more experience, because trading the other phases, B and D and A2, they are a bit trickier, particularly ranges as well, right? I want to stay out of those. So just kind of another general rule of thumb, like use LC1 in scenarios when you would consider taking, a medium time frame risk entry, right? So, this start of phase C, initial IBOS, big risk reward on our side. There's only kind of one or two POIs to pick from. Sometimes that's when, I'm just literally just going to set my limit order here on the M15 or the medium time frame. I'm not going to bother waiting for an entry model. I just want to get involved. Risk reward is still great. It's just high probability. They don't happen every week. They don't even always happen every month. I mean, you're probably going to get at least one of these every month, to be fair. But when I see them, high conviction, bang, I want to get involved. That's when you kind of want to be thinking LC1. Really refined, high probable scenarios. Okay. And then obviously doing it on a high probability medium time frame POI. So what makes a high probability POI? Well, building the narrative with the phases is probably the biggest step to getting that right first. If you're doing the right phases, i.e. start of phase A and C, you're already well on your way to probably getting a high probable POI. Okay. But obviously the other things that we've spoken about through the course, something like an unmitigated extreme. Okay. So when we get that bearish IBOS and prices pulling back, right, this supply zone is going to be the unmitigated extreme of that level, right? It's the highest supply zone that's, unmitigated. That's going to be a high probable POI. Is it a sweep flip? Okay, so sometimes like this POI here, it reacted from this supply. So we flipped it, broke structure, it swept liquidity, right? That's going to be a high probable POI, especially when you combine it with phase C, it's part of a demand chain, etc., etc. Even if that wasn't the unmitigated extreme, imagine there was actually a pivot candle down here behind it, I would still view this as a high probable POI, right? Because it's a very clear big flip reaction, clear sweep liquidity, nice impulse momentum. Clearly that's where the demand came in that led to the IBOS, start of phase C, that's high probable. Even if there's maybe an unmitigated pivot behind, I'm still willing to get involved on this sort of thing, okay? And yeah, if it's got some lid, even better. If it's part of that supply and demand chain, like we're saying, and you want it to be well priced within the swing range and within the internal range, right? Try and tick as many pieces of positive confluence in your favor as possible. So, in more simple terms, do you have high conviction that the POI you are looking at will hold? Is that trend, internal swing, is going to continue? Okay. So I think a lot of you, especially if you have a little bit of experience, you will know those times where price action is just developing and you just know you have confidence. You have high conviction in what you're seeing. The directional bias is clear. The POI is very, very clear. You're not and ahhing. Is it going to go this way? Is it going to go that way? What POI do I pick from? It's a little bit messy. It only broke a little bit of that structure. It's not really that. Do you know what I mean? If you're kind of squinting at price action and you're not sure, don't even be thinking about LC1. LC1 is when you're right, super clean. You have confidence. You know what I mean, right? When you have that feeling, that's when you want to think about LC1, okay? So that's kind of the more general points out of the way, but this can be something useful to sort of think about or put into an initial trade plan. So let's go through the phases in a little bit more detail. So your medium time frame swing structure is bearish, right? This is like a medium time frame swing pullback, and then we get that medium time frame boss to the downside. Now, as we know, when the internal structure is still bearish after that bearish boss, if we were looking for shorts within here, we classify these as phase A2, right? This is a very tricky phase to master because, as we know, after a swing break of structure, at any point, that swing pullback can kick in, right? And we're trying to short from here, thinking that the internal trend is going to continue. We don't have a much risk on our side. We never know when the swing pullback is about to kick in. That's why phase A2 is very, very tricky. And again, you should only use it in very specific scenarios. Ideally, when like it's here, there's no key level to the left nearby, momentum is very strong, but even then it's hard to know if it's going to keep going. Now, this is kind of an obvious scenario I've drawn here of when we definitely shouldn't be thinking about phase A2 shorts. And that's when we're coming off a higher time frame demand mitigation. Okay, so this gray box being, say, higher time frame demand. Like, obviously, we don't want to keep trying to force these shorts because, yeah, they can continue, but we know over a large sample size, is it really worth it? I'm going to say no. Okay. Also, what do we have here? We have a strong liquidation. So we can see like a little bit of an M15 fake break. Maybe there's like an M15 chock. That low then gets liquidated. Maybe there's some nice big obvious equal lows as well. We get that liquidation. Price is putting back up. Yes, the internal and the swing trend is still bearish at this point, but come on, you have to start building the picture, right? We're coming off higher time frame demand. We've had a medium time frame strong liquidation. There's a lot more evidence now to suggest that we're potentially about to get that pullback, right? This is the time to be patient. Even if this plays out, don't get FOMO. It's probably not worth it in the long run, and you'll find that in your backtesting if you kind of backtest these trades, okay? So you can read these in a bit more depth. I would say keep it out of your plan. Like I said, stick to phases A and C. So this is phase A2. Phase A is over here, which we'll talk about in a minute. Okay, so that's a nice, easy one, in my opinion, to stay away from. And there will be times, yes, when the market literally just trends and trends and trends, and it can be a little bit frustrating if you're not involved. But you'll see, again, don't take my word for it. Find it in your own testing. See if you have success with A2. But I would say, for the most part, it's not too worth it. Okay. Okay, cool. So we get the strong liquidation. We get the hard time frame mitigation. Now we get the bullish IBOS. So now if we're looking for longs are pro medium time frame internal structure, right? Because the internal structure shifted bullish. Yes, we're counter swing, but we're pro internal. So for me, phase C is high probability, medium to high probability in most scenarios, okay? Which is again why I'm saying just focus on phase A and C for this, but particularly the start of phase A and C, right? When you get that first initial IBOS, and it's like a really convincing IBOS, nice strong liquidation, hard time frame mitigation, all those things are going to make it better. But if you've got a clear bullish IBOS and prices coming in, this is when I really love it. This is one of my favorite phases. I want to get involved here. Okay, so this is a good time to be thinking about LC1. But again, it's not just because it's start of phase C. You want to be taking into consideration all of these other things. I would say the next, or probably one of the most important parts of this, is that it is a tight and small range. Okay, like for instance, this is a large swing range. So by the time price is up here, like any lower time frame lid down here, this is way too far away. Whereas when we're working with this internal range here, this bullish internal range, and the trade idea is to play a continuation of that next internal leg, this is not always, but a lot of times going to be quite a tight range. This is when I can think about using LC1. So let's say we've got like this POI here. Okay, I'll be happy to look for LC1 from here. Obviously, it's not drawn on this chart, on this example, but we can use lower time frame lid. So although there's no lid on the medium time frame here because it's one straight push, when price is coming back, if you look left on a lower time frame, obviously for LC1, you'll need a lower time frame low within here, right? A little like M5 low or whatever your lower time frame is. So then if you draw your strong liquidation point across, right, that can be your LC1 entry. I'm happy to take in this occasion. High probable POI. It's a sweet flip, led to the IBOS. Ideally, it has like a demand mitigation. And again, like I said, sometimes you might get like a little, unmitigated pivot extreme. But generally, if this is like a very obvious, nice pullback flip, something quite convincing, maybe the bottom of the flip like mitigated the demand range, like a little bit of sell to buy range down here. All these times, it gives me high conviction to get involved because especially at the start of a new phase, it doesn't always pull back to the extreme. So I'm happy to get more of that decisional kind of POI here. With momentum strong, if you look left here, there's no opposing key levels, right? You guys will see these types of trades. I'll show you some more examples in the future videos as well. Like that's when I just want to get involved. I'm almost looking for an excuse to get involved. That's the type of mentality you want to have if you're thinking about LC1, okay? And there's more stuff more in here, right? Hard time frame demand mitigation, MTF strong liquidation, bullish IBOS to the upside, very likely now that that swing pullback is starting. We might be wrong. Sometimes you'll get it wrong. We'll get the IBOS, we'll get involved. We're too early, we go down, and then the real move happens. So be it. When I take losses in those scenarios, I literally don't care. Okay. Yeah, tight MTF range, well priced. Pretty much no cause for lower prices. Okay, they're the sort of scenarios we want. Now, if we start to, I haven't drawn it on here, but imagine we start to kind of get continued bullish internal ranges from within here. You can consider, let me just kind of draw it a bit better. Like say here, we get another bullish IBOS and there's another demand here. Of course, you don't have to only take the very, very first phase, but this is going to be the most ideal scenario. You can consider taking LC1 here, but it's already becoming more medium to lower probability because we're getting more into the premium of the range. The internal ranges are less well respected here. Sometimes it can sweep, then go, or whatever. So again, you need to judge that as you get more experience. Like every scenario is different. How are we in the premium? How near are we to a supply range? Is there a high here that price maybe is sweeping, so therefore we may get a deeper pullback before we go higher? Like all of these things you'll need with experience. So generally this is the best, but it's not to say that you couldn't consider something here, right? I can't cover every single possible scenario in one diagram, right? So this is why you guys need to use a little bit of common sense. And it's more about understanding the logic rather than trying to memorize this like an exact scientific journal, right? Do you know what I mean? It's getting the general idea, understanding the logic and theory behind what we're doing, and then using your own common sense to know, when and when not to consider to get involved. You don't have to master this overnight, but these are kind of, I think you guys get it, right? This is the stuff that's going to take a little while to really get concrete in your mind. But this framework, when applied to every type of scenario in the market, will help you massively. Okay, so I think you kind of get that. Start at phase C is great. Now we're obviously up into the premium and we're starting to come up into these decent levels of supply. So definitely want to stop thinking about taking longs, and our focus now wants to be on taking shorts. So if we were to take a short at this scenario, this is going to be pro swing trend, right? Because the swing is bearish, but it's going to be counter internal because this was the last bullish boss. So if we're shorting against that, it's counter internal, right? So if you refer to your MTF phases cheat sheet, this is phase B. Phase B, for me, rarely high probable because you're trading against the internal trend, right? Which is why I say here, pretty much we always want to be trading pro-internal for it to be high probability. That's my favorite a lot of the times, right? So not to say you can never trade these, but I would say only if you're going to do it, try until you're consistent, try and only do this with like LC2A. Don't bother with LC1 for the most part, okay? Especially when we've got a big range like this, right? These are the more immediate internal ranges, and then you're trying to short here and you're using some like little lower time frame lid within here. That's a far way away. Like when we get the POI mitigation, you're dropping down to your lower time frame, you're looking left, and you have to scroll out really, really far. Like that's not a good time to be doing it. You're probably going to take a lot of losses most of the time, okay? And that's what I've said in here. Counter MTF terminal and momentum, it's a large swing range, so don't use any of the lower time frame lid within here all the way from the left. It's never really going to be a high probable scenario to consider LC1. There are cause for higher prices behind, right? Liquidity behind this high, but more importantly, we've got the unmitigated high time frame and medium time frame supply. Just, don't let it get involved. I mean, even better, wait for an MTF chock. I haven't drawn it here, but technically that would give you a new POI. Okay, maybe you could consider LC1 within there, but again, it's still not the best. Whereas this here is still phase B, because this is again pro swing but counter internal. But why is this a little bit higher probable? Why is this a bit better than this, even though they're both phase B? Well, for a few reasons. Probably the main one is that we've now come into the unmitigated extreme supply of the swing range. So this is the supply that needs to hold if the MTF swing range is going to continue bearish, right? If this swing trend is going to continue, this is a good POI. Now, just because it's the unmitigated extreme doesn't mean you should always take these trades, because there's going to be times where you're going to see there's going to be a lot of evidence to suggest that we're probably going to switch bullish, right? So it doesn't mean just blindly get involved just because, in theory, this has to hold for the swing trend to continue, right? But anyway, the reason why it's better is because one, we have this POI, so it's a good POI. Two, we've taken some lid, right, for this level. Doesn't mean we need to trade it as an entry, but it's a good confluence for this POI to hold. And really they're the main reasons, to be honest with you. So it doesn't necessarily make it high probable, but it makes it better than this one. Okay, and also, that was the other one. We've got a strong liquidation here, right? With the fake break, strong liquidation of the MTF fake break and the lid, right? Just more confluence stack in your favor. So consider it, but it's still a little bit more advanced. Now, when we get all of that, and then we get the bearish IBOS confirming that this is holding, right? We're really starting to build a big narrative, and I go through all of this here. This is now phase A. So shorts are pro swing and pro internal. We have full alignment. Very, very, very strong signal that this swing pullback is now over. And now we can look to follow those bearish internal ranges to target this low. Okay, strong liquidation, extreme mitigation, bearish IBOS. This is like this here and this here. These are my favorite trades when you can get them when they line up. You're not going to have 100% strike rate, but when this happens, I'm getting aggressive to try and get involved. Again, particularly when it is a tight and small range, right? In this case, it hits the unmitigated extreme of this internal leg. There could be lid. There's so many different ways it could be better, but this is the general area I'm looking to get involved. I'm happy to consider LC1. Again, we get another bearish IBOS. So this is pretty much the same as here. It's not quite as well priced, but it's still well within the premium, right? It's like first kind of initial phase. Sometimes you get kind of 2 or 3 initial tight phases, and then it kind of goes sometimes. If you can get that, I'm happy to get involved. Obviously, we've got lids here as well. And again, there could be like a POI here. Yeah, perhaps I'd look to get involved here as well. Obviously, this is going to be the better one because there's an unmitigated level behind, right? I can't cover every single possible scenario, but this is the general way to think about it. Okay, this level here, if we look left, we're not coming off a significant level of demand where we could potentially expect like some shenanigans, right? There's plenty of risk to reward to the downside. Now, when we get down here, yes, technically you could be looking at phase A all the way down here, but you have to understand that as we start to come into these lows down here, even though we expect this swing low to now get broken, it doesn't mean price is just going to come down and take it. Sometimes it will, but then a lot of times you'll see there's going to be a bit of demand down here and we'll start bouncing around a bit. We'll start chopping, and then eventually we go. Right, we can chop around during Asia or whatever, or into the weekend. So trading down here is not well priced. It's lower probability, which is why we want to get aggressive up here. We're not worried about taking losses up here. This is the time to take losses on shorts. This is the time to not worry about taking losses on longs. Okay, these are the times to just think about, I don't want to get FOMO. I'll let it go without me or whatever. Okay, and obviously phase D, I would just say 95% of you just don't even have phase D in your plan. This is a particularly not a great time to trade phase D, which should be get buying counter swing and counter internal. Why? Because the objective is already complete. We've already pulled back up, so now we're expecting this low to go, right? Not a good time to be doing phase D. At best, you could play a bit of an internal pullback before we go, but okay, you might want to do that, but do not be using LC1 for that. Especially this is probably going to be quite a big distance. Like the distance between here and here is going to be quite big. You don't just want to be using like some little lower time frame, liquidation of a little lower time frame low down here, trying to buy against all of this. It might work here and there, but what's the point? Are you going to risk, 100 grand on that trade idea? Why do I say 100 grand? Well, I'm trying to get you to think big, think about what you want to be trading in 3, 5, 10 years time. If you're not going to be doing this for the long term, then why are you bothering putting yourself through all of this, right? You need to be thinking big and thinking, is that what a professional was going to risk their capital on just for a quick move because, they've seen their favorite Instagram trader take 3 trades that day, right? Get that crap out of your head, get very clear in your plan, what phases you are going to be disciplined to execute on, and start off with a very, very rigid trade plan. As you earn the right to have a bit more discretion in your plan and to be a bit more loose, then you can, do that, be a bit more loose and have a bit more discretion. I would say at the start, it's almost better to be kind of almost overly rigid, just so you can practice the art of being disciplined, right? You're not going in with I just need to have the perfect trade plan to pass phases and make a ton of money. No, it's about giving yourself strict rules to understand how to be patient, what to look for, how to build accurate data, building that experience, building that psychological experience, earning the right to know when and when not you can bend your rules. You can't do that at the start. You need to be more rigid. For those of you who get more experience with it, then okay, yeah, there are some times where phase B makes sense. There are some times where I might get aggressive with a phase D. I do now have experience to know when to take phase A too, right? You got to earn the right for that. So hopefully this, I guess you could call it a cheat sheet, is going to help you. It's very, very, it's based on all the same principles of all of the medium time frame phases lessons I've done and throughout the LC2A stuff in the previous trade plan module, this too. It's just, I'm just going to keep going over it. I think I'm just going to make endless content on this until it's drilled deeply into your guys' subconscious, because it really, really is super important, but even more important with LC1, because it is a very, very aggressive entry model, particularly if you were going to use it with lower time frame lid. I've kind of made myself as clear as I possibly can with this. So watch this again and again, save down this sheet, And yeah, I'll try and create as many real life examples to put the theory into practice to really drive the point home. But you've just got to be careful trading this entry model, because this entry model in the wrong hands, it can lead to all sorts of problems, okay? Alrighty, let's go through some trade examples, and I'm going to separate these out in terms of phases. So let's look at phase A first. So of course, phase A is when we are trading pro swing and pro internal, right? We have that full alignment. So on this diagram, this would be a phase A trade, and this would be a phase A trade if we are taking shorts, because after this bearish IBOS, the internal structure is bearish, the swing structure is obviously bearish, so we have full alignment. These are the types of high probable trades you want to trade with phase A. So here's an example where we have bearish 4-hour swing structure. Okay, we've got that 4-hour break of the low. Price then traded up, and it did break the 4-hour swing high. However, we can see that it was just a wick break. It failed to close above the high with a candle body close. Therefore, it is not a bullish break of structure. And then since then, you can see that price has just started to make its way down. So ultimately, this is still a weak 4-hour swing low because it's failed to do its job. It's failed to cause a candle body break of the high. So ultimately now we can look for price to target this low. Okay, so with the 4-hour, we have that bearish bias with some nice equal lows building to target. If we now jump down to the M15, so this is going to be our medium time frame. So this is our main time frame for building our directional bias for the session, and then identifying the medium time frame POI in which we're going to trade that directional bias. Okay, medium time frame ideas, medium time frame POIs, lower time frame execution. So as we can see here as well, the M15 swing structure is aligned bearish with the 4-hour swing structure, as we've got that last break of structure here to the downside. Now, price did pull up to this M15 POI here. This was around the Asia session time, see 2:30 GMT, and then had a bit of a corrective move down and an M15 chock. But we can see that, like, you know, the internal structure is still clearly bullish. So when you get your desk, say, around Frankfurt Open before the London session, yes, we've had a bearish chock, but you can see price action is kind of quite corrective, and there isn't any real super clear and mitigated POI at this point when price is pulling back. It's all kind of being mitigated. So it's not too surprising then, with all of that buy side liquidity building up, that we see this impulsive move to the upside, okay, giving us another bullish internal break of structure of this high. Okay, so hopefully you can see now that if we were to take a short from this POI, it would be pro M15 swing, but it would be counter M15 internal. So that's actually phase B. I know this lesson is going to be on phase A, but this would be phase B. Okay, now if you're ever going to trade phase B, the best time to do it is kind of like this, whereby you are entering on the unmitigated extreme POI. Why? Because this is the area in which we expect the swing pullback to end. Okay, so if you're going to trade short here, which is against the bullish internal trend, we want to do it when we're expecting the internal structure to reverse. And we expect it to reverse when we think the overall swing pullback is finished. And because if we look left, this is literally the last unmitigated M15 supply zone within this leg, within this range. That's why it makes sense if you want to trade phase B, these are the sorts of times to do it, right? Because you're expecting the internal to reverse, but of course there's no guarantees. So if you are going to take a phase B short, ideally you can get in here before price pulls back down, you know, into like demand at the strong low, because then of course price could push higher, okay? So that would be phase B. Now, technically if you wanted to trade this, right, before I even jump down to the lower time frame, you can see there's clear M15 lid here, so we know obviously it's going to be valid on the M5 as well. And this could be a potential entry for you, right? There is lower time frame lid to the left. It's visible in the M15, which makes it, you know, higher probability. It's more significant if you can see it on a higher time frame. Time is power. We have the POI mitigation. We have the liquidation of the lid to the left. Okay, so technically this could be an entry, right? And you could size it up like that. Now, these ones are kind of tricky to, to categorize with probabilities. I would say it's kind of on the lower end of medium probability for me. One, because it's phase B is trickier, like I keep saying, because you're trading against the internal trend. But two, this is quite a big swing range, okay? This is quite far away to the left. So as I was saying before in the theory lesson, we don't want to be using lid all the way here to the left and then entering short on a liquidation of this lid. We want it to be very, very near, ideally. Like if we were getting short here, you see how lid is like right beside it. So it's like a tiny little internal range. These are my favorite ways to use LC1. Using structure all the way to the left like this and then trying to short it here, right, when we liquidate that lid into here, much, much, much trickier to do. So, I haven't even really looked out to take these sorts of trades really in the back test of, to be honest. I'm focusing more on the immediate price action, but I did just want to go over that in case anyone was looking at this. Perhaps that's something you want to test and you wanted to implement, but my recommendation would be that you focus on what I'm describing, which is the more immediate price action to the right, unless the swing range is a lot tighter. So this is kind of where I'd classify this as old price action to the left. Obviously, there's a bit of discretion with that. So it's a nice trade if you took this one, if you wanted to enter on this, but it's the type of trade I would personally say stay away from, at least until you gain more experience. It's not the type of trade I'm personally going to be looking at least at the time of recording. It would be too far away from me, okay? But this ends up being a winning trade. I won't draw it out for the interest of time. Now, what I'm going to show you is phase A, where things become a lot higher probability, because if we're just a little bit patient, because at this moment, right, what could happen is this is a strong internal low, right? So although we've had a mitigation of the extreme level of supply, and we know this is a decent area in which the swing pullback can finish, and we can get that next move, we obviously don't have confirmation of that until we get the bearish IBOS, because there is every possibility that this could hold and we could push up higher, right? The market can do whatever it wants. So trying to short against this is possible. It makes sense to do it here because it's the last unmitigated level, as I keep saying, but it's only when we get this that now you have, okay, a lot more confluence going for shorts, right? So we get that bearish IBOS. So now both the swing and internal are aligned bearish. Happy days for shorts. A few other nice little pieces of confluence. Like I said, obviously we sweep some lid here to the left into that extreme POI mitigation. We also got with this M15 shock here, use this here, that then turns this bullish IBOS also into a strong liquidation, okay? So yes, it is a valid bullish IBOS, but it can also be a strong liquidation at the same time, right? This is a high that broke some structure, price then comes up, liquidates the liquidity behind that high, it's the Asian session high as well, and then we get the bearish IBOS. Okay, so let me keep it nice and simple for you. The 4-hour structure is bearish, the M15 swing structure is bearish. We pull back up to pretty much the highest probable POI in this swing range that needs to hold if we are to remain bearish. We've liquidated some lid to the left. We've had a strong liquidation here with the immediate price action of the Asian session high, right? This is a high that broke a low. Prices come up and liquidated those orders. Nice big V-shaped reaction, showing that it's likely, the big guys are using the buy side liquidity behind that high in order to fill their short positions, okay? And then in the most simple and powerful confluence we have a bearish internal break of structure. So even if you don't really fully get all of the liquidations and everything and whatever, very simply, our internal structure has now shifted bearish. This is our strong high. We now expect these bearish internal ranges to hold until the weak low goes, right? It's pretty much the first thing you learn in a technical analysis module. Okay, so we know our directional bias, we want to get short. So then step 2 is identifying your medium time frame POI in order to play that directional idea. So our directional idea is bearish. Let's look for a supply zone. Well, we've got the extreme supply zone here. But what can we see? It's pretty much kind of already had that clear mitigation, right? Where we came down, pulled back into it, and we came down. So I would view that as basically mitigated, and then you can move that along to the next clear level, right? This is another buy to sell candle that gets engulfed. So this for me would be the clear POI in which I'd be looking to short from. So now what we can do is we can look for either LC2A, where we drop down to our lower time frame, right? Let's get rid of this phase B LC2A trade there. Sorry, LC1 trade. But here, this is the trade idea we're now doing, right? Phase A shorts. We are aligned with, like I keep saying, M15 swing and internal are bearish. So now we can look for an entry here. So the first thing I'm always going to be thinking about, ideally, is the fake break liquidation that forms in the pullback. So for LC2A, what do I want to see? I want to see price come back in. I want to see a high that breaks a low, right? Then look for the liquidation of that high. That's your liquidation. And then we enter on this candle here. That is LC2A. You should be very, very comfortable with it. If you're not, do not start trading LC1 because LC1 is a lot more aggressive, okay? So now we start to get the pullback, and what we'll be looking for LC2A, like it said, right, is that for that to form here, okay? But we can also use LC1. Now, there isn't really any clear structure in this leg. It's a little bit more of a subtle one, but this inside bar is a valid fractal high, okay? It's a structural high because this is a candle that fails to break the previous candle's low. So it's a bit of a weird one, but if you guys are comfortable with the fractal structure rules we use, you will know that that is a fractal high at this point, okay? Obviously, we get a bullish change of character down here, but this counts as a fractal high, as it is an inside bar, okay? So we could be waiting for the fake break liquidation. This high has not broken the low all the way down here, so there's nothing going on. So what you can then draw on is your liquidity point here. Now, before we even get the liquidation, you want to be very clear in your mind before any of this happens. Is like, okay, is this valid lid? Well, yes, it's a structural high in the leg to the left, right? That created the POI. Okay, fine. But is this an environment in which I should be thinking about LC1? Well, step one is it's phase A. So we know this is a high probability phase. Phase A and phase C are our favorite. So that's a good thing. But two, look how tight this internal range is. You see how it's like this? It's a tiny little small range, and we're going to be using some lid in here. Whereas, when I was talking about this phase B trade here at the start, that's the range you're then talking about, and you're talking about lid all the way to the left. So do you see the difference in size here? You've got this massive range there where you're trying to time a liquidation of that with this. Okay, fine. I'm not saying you should never do it, but I'm just saying that's a lot harder than this tight little range here, this immediate POI, and you're looking for some lid right within here. It's a lot easier to time this. And this really is what I'm trying to push you guys towards, to focus on only thinking about using the entry model when you see this sort of price action. Okay, this is how I'm personally approaching things, which is what I tried to make really, really clear when we went through this theory lesson. So this is basically this trade here. I didn't even mean to do this, but this is basically this diagram is a very, very good representation of this live price action back in 16th of Feb 2023 on EU, right? Pull back into the extreme, liquidation of clear medium time frame lid to the left. We also had a strong liquidation in the more recent price action here. Remember? There you go. There's a chock, liquidation of the high into the extreme, liquidation of the lid. But more importantly, the really good piece of confluence, if we keep it simple, is we got that bearish IBOS. This then becomes our strong internal range, and we're just looking to play the continuation of this range. Okay, this is, when I see this set up, it doesn't happen every week, doesn't necessarily even happen every month, but this is, for me, go time to be as aggressive as I can and look to get involved for that movement. Okay, but again, the key thing is it's a tight range. So yeah, we can look for the liquidation of that high. There we go. Alert goes off, there's your liquidation, and then it's the same sort of method we use for LC2A. Stop order, sell stop order below the low, and then whatever pip buffer you want to use. Now, on this candle, 2 pip buffer almost gets me at the high of this, so you might just want to use a little bit more, half a pip or so, especially when we're entering right at the top of the swing range, right? And you've got big risk reward towards that low. So just extending your stop loss by a few pips isn't going to make a big difference, especially if you're just going for that 3.3 target. Just give yourself a little bit more stop loss protection. You can use a little bit of common sense in those scenarios. We push up higher, so we'd cancel our order, readjust it to this candle when it closes. 2 pip would give us the 4.4, and that just puts it behind. So there you go. It makes sense to leave it there. Do we get tagged in? They're in, right? Now we're in the trade. So set and forget. You do nothing until this plays out. We push up a little bit higher. Nothing to do here. Okay. And if I just play this forward a bit, it does chop around, and there we go. Okay. So yeah, with the LC2A entry model, there was no entry because we get a pullback. This high doesn't break a low to the left. Okay, fine. So that's not a strong liquidation because it's a weak high. We then push up, we pull back, and we push up. This high doesn't break any structure to the left, right? So this is not a strong liquidation, it's a weak high. And then we just move away. Okay, so there's no strong liquidation in here in the pullback that we could have used for LC2A, because once we get the highest point, it never gets broken, right? We get the M5 chock here, so then you'd be looking for a liquidation of that high. You ignore all of this, and actually if we got a liquidation of that high, then the POI itself would have failed anyway, so then the trade idea would be over. So there was no way to capitalize on this position from this POI in this example, unless you use the LC1 entry model, okay? Now, that said, you don't have to. It's unrealistic to be able to catch at every single move anyway. So if this didn't give a trade setup, it doesn't give a trade setup. It's not the end of the world, okay? You can't be in every single move, and you don't need to be to make insanely profitable returns over the course of a year. But you see how now this is a very complementary bonus entry model to have to add in to trading it alongside LC2A, okay? But again, very, very specific scenarios. Ideally, you're doing it in these high probable scenarios where we have, this is a great example of so much confirmation from the medium time frame that we're now ready to target this low. Pull back to the extreme, liquidation of lid to the left, strong liquidation in the more immediate price action, giving us that strong liquidation on the M15, Asia equal highs. We get the bearish IBOS, shorts are now phase A, okay? Really small range, there's literally only one POI we can look to trade from. Nice lid within the POI, right? We're not using lid really, really far away. Like these textbook entries are what looks like this, okay? This is what you want to be leaning towards when you're thinking about LC1. Because like I said, technically, this was an LC1 trade that was phase B, right? Liquidation of lid to the left into our POI. We look at the M5, right? I'm not telling you what you can and can't trade. This is a valid LC1 trade. It's just you may find these a lot harder to have good results with when you're using lid far away. And that's kind of why I try and think, how can I help you guys to kind of have a bit of a rule to define whether the range is too large. And this is what I said, when you look at the lower time frame, can you see the lower time frame lid to the left and the LC1 entry at the same time without zooming out? So what does that actually mean? What it means, when you're looking at this entry here, right, I can't see the lid to the left. I have to zoom all the way out. Now, okay, you don't have to zoom super, super far out, but it's very, very different when I'm looking at this and I'm looking at this entry here, right? This entry, can I see the lid? No, okay? What about when I'm looking at this entry? Well, yeah, it's right there, right in front of my face. And that's kind of what I mean as a general rule of thumb about what can help you to know, am I forcing things here with LC1 or not? This is a perfect example, okay? So I'll leave that there. We'll go through a few more examples in phase A, but yeah, hopefully that all makes sense. Alrighty, so let's take another look at LC1 with a phase A trade. So in this instance, the 4-hour chart is actually bullish because when we had this last break of structure, there was no significant pullback in here. So it ended up giving us a very, very large swing range. And at the point in which we're looking at this trade example, we were coming into the strong 4-hour low. So usually that's when we start to think about obviously trying to get long if this bullish trend is going to continue and we're not really too keen on shorts. But in this specific scenario, because we have such a large swing range, this is where we can actually place a lot more weight on the more recent price action. And we can see, if we just look at the internal price action, how clearly bearish that is, how well it's respected. We did have a sweep of the highs there, so we didn't get a bullish boss. Another break to the downside, another pullback, and another break. So literally for since the 18th of July to August, nearly a month, we've just been heavily, heavily bearish. So yes, we do have to be aware there's a strong 4-hour low here, but this is where we can just, especially if we're trading, M15 ideas with M5 entries, we can weigh far more importance on the more recent price action and continue to follow that bearish order flow. As we can see, supply is just clearly in control, right? So if we jump down to the M15, it's even clearer. Just zoom out a little bit so you can see the recent swing structure, right? Where we got this break of structure to the downside, we got a pullback, another break of structure to the downside. All right, we pull back into pretty much the extreme supply within here, and then we got another bearish boss. So we can see the clear bearish trend overall. Now, I played price action to just before the London session open, which is obviously, we include Frankfurt open with that for us, just before 7 a.m. UK time. So this is literally how my charts would look if I got to my desk, just before I'm about to trade the session. And this is my thought process of how I line up a trade idea. So we know the 4-hour internal structure is bearish, so we're going to keep with that bearish bias. The M15 swing structure is also bearish, right? So that's going to be our directional bias for the session. Okay, we've pulled up to the premium of the swing range. So there's increasing probability now that the swing pullback is over. Yes, we haven't quite mitigated the extreme level of supply, but we know that we don't have to. We have taken some significant liquidity to the left here on the M15, which is just another sign that the pullback may be over. Okay, and then since then, it's not the largest of internal structure, but you can start to see that bearish order flow really starting to kick in since we've liquidated that lid to the left. Okay, so when this sort of happens, this is when you can just follow that immediate order flow to look to get involved. Right, so I'm drawing the supply just on this buy to sell here, but it may as well include the wick, okay, in case we push up a little bit higher. All right, so this is exactly how I saw my charts. If you look back on, so this date is the 18th of August. If you look in the old analysis in Discord, you'll see this is exactly how I had my pre-session analysis before this session. And this is where I'm now looking, completely focused on shorts to trade from this POI to look for price to target this low. Now, yes, there is some demand here that led to a break of these highs, but when you see price action that forms like this, pretty much just a straight leg. That's kind of just a pause in price action. It's not like you got like a significant pullback that then does that and sweeps liquidity and flips supply, right? This is kind of just Asian session low volume trickling up, kind of ascending highs like this. When you see that, this is not the type of POI to be too concerned about. Generally, this is low resistance liquidity, stacking liquidity there that typically will get taken when that pullback objective is likely complete, which is what we have here. Okay, so in simple terms, we've pulled back during Asia, taken liquidity, and it's now looking like we're going to get the continuation of this movement here to the downside, right? So if we're taking shorts, this is what I would classify as phase A, because again, it's pro-swing, pro-internal. I know it's not the most significant of internal structure, but it's what we have to work with, okay? And it makes sense from where we're coming off. So if we look at the diagram, this is basically like a trade like here. Nice tight price action. We think the pullback is over. It's go time to follow the low. And this is essentially the internal range I'm talking about. You see how tight and small this is? So this is why I'm thinking about we can potentially use some lid here to the left, rather than like something like this, where let's say there was like an M15 high here, and then prices coming all the way over here, right? And then we're going, right, can we use this lid into here? Maybe you can do that, but that's not the type of high probable scenarios I'm talking about to think about it. This is a tight range, immediate price action, right? We're just looking for price to go. So if we jump down to the M5, obviously, we'll still be looking for the LC2A method to occur. So for that, what would I want to see? I would want to see a high that breaks a low, right? That's then a strong high that caused an M5 chock. Then we would look for the liquidation of the high. As long as the POI is respected, that would be the entry, right? But this, because like I said, all the confluence, we can look for LC2A. Now, what constitutes as valid lid? All of these highs here, I'll draw them on for you. All right, that was a little bit higher as well, would have all been valid levels of lid. Any structural high you see that has not yet been liquidated, right? These are all potential highs. But let me just keep it simple for you. What do we need to wait for first? We need to wait for our POI mitigation. So let me play this forward, a few candles. Now we get our POI mitigation, okay? So now just take the nearest level. You don't have to draw all of these on and go, right, here's that nearest level that's been liquidated. This is our freshest level of strong liquidity. We know there's going to be liquidity behind the structural high. That has now been taken, okay? Here is the PBL that liquidated that M5 lid, okay? So we now know this is still relevant for us. Let me just make this into a liquidity line. Because the PBL is still active, right? The PBL has not been mitigated and made a higher high. So this means we can look to get involved, okay? That's the mechanical rule we use to determine if this liquidity is still relevant to trade from here, right? Because let's just say the POI was a little bit, just say it's higher, right? If you can imagine it was higher. Now imagine if we liquidate this lid here, price then pulled back, mitigated this PBL, right, the point before the liquidation, and then price pushed up higher and made a clear higher high with a candle body closure above that high. And then we got our POI mitigation, and we were up here, and we were asking, okay, is this lid relevant? Well, no, because the PBL held and made a higher high, right? So that's when you wouldn't take the trade for this lid. But in this instance, we've got the liquidation here, the PBL is still active, therefore we can look to get involved on this trade, of course, if everything else lines up, right? If you can get suitable risk reward and all of that good jazz. So 2 pips stop loss above gives me nice protection above the high as well. And then if we look for 3.3, ideally we can get it within the range. Okay, just about there to the low. And that's the idea, okay? So again, phase A trade, we have to let it play out a little bit. But yeah, it's more about like the tight range. Phase A is obviously generally always going to be high probability. So even if you don't get the most perfect of tight ranges, at least you're trading pro-swing, pro-internal structure. You're going to be on the right side of the market far more often than not. But this is what I mean, like the extreme small high of that internal range, it's the extreme POI. It's just super clear. Now, does this type of price action happen every day? No. But when it does, that's what I'm saying. This is when you have to recognize, right, this is go time now, foot on the gas. I'm almost looking for an excuse to get involved. This is when I'm going to do it, right? Rather than when you've got, big ranges and there's kind of highs everywhere and you're not sure which POI, like that's not the time to be just trading, any of these like sweeps all here to the left. It's when you've got this really clear, immediate price action, immediate order flow, like one POI to choose from, nice tight price action, Like that's really kind of what you want to see when you're thinking about LC1. Alrighty, so let's take another look at a phase A LC1 trade. Now, in this example, the M15 price action, it's a fair bit uglier than the previous examples we've looked at, but I think this is a good example to show you of how you can trade the market a little bit uglier, but within reason, okay? And it's because it's backed up by the higher time frames. And yeah, let me just show you the confluence as to why you can have confidence to trade when maybe the market doesn't look as beautiful as sometimes we want it to, we want to wait for, but will become clear as I go through it. So 4-hour swing structure, hopefully you can see we've clearly switched bullish, right? And we've had this sustained 4-hour bullish trend and then started to gain a lot more momentum. Now, arguably, this is kind of one of those a bit of a debatable pullbacks, whether you would view that as internal or swing structure. When this was live in the market, I viewed it as an internal pullback, so I'll be consistent with that, okay? But what happens when we come into this strong 4-hour internal low, right? Because at this point, we're not sure when price is coming down, are we going to have a deeper 4-hour pullback before we potentially higher or potentially, we even reverse? But what do? We come into a nice POI. Why do I say it's nice? Well, it formed really well, right? Nice big candle, big thrust candle that closes above it, leads to a break of structure, nice big impulsive move, and it also took liquidity, right? So this is textbook of how a textbook, strong POI would look. We come in with a fair bit of momentum, but then what happens? We get a 4-hour bullish change of character. Okay, so that is a very good signal, not a guarantee, but a very good signal now that that's the end of this internal pullback. 4-hour bullish chalk after mitigating this extreme internal demand, really strong demand, big V-shaped reaction as well. Okay, now it's very likely that price is ready to target this week high. Okay, pull back into a zone, 4-hour bullish chalk, V-shaped reaction, right, big wick, showing that momentum. We're coming back into this 4-hour demand, right? We can draw that on. It's not the most significant demand in the world, but it did, this sell to buy candle, right, did lead to that 4-hour bullish chalk. We pull back into here, so now it's very likely that we're just looking for price to make its way up to at least this 4-hour high here, okay? So the 4-hour chart is painting a pretty decent bullish picture. But even before I jump down to M15, I can see we've ranged for 1, 2, 3, 4, 5, 6 candles, which is going to be 6 times 4, about 24 hours, right? So I know the M15 is probably not going to look amazing. But let's jump down and let's take a look at that and see if we can make some sense. Now I'm going to zoom out a little bit because in this specific scenario, it did actually give us a really big M15 swing range. And the reason why is we had this M15 swing pullback here. We got a bullish M15 breaker structure here. We then pulled back. We failed to close below that low. It was just a sweep. Okay, so we actually remained bullish. And then we got a break of structure here. The reason why we end up having such a big M15 swing range is because after this break of structure, all of these pullbacks here were not significant. They were not big enough relative to the recent price action for me to classify these as swing pullbacks. So all of these are just M15 internal pullbacks, okay? And then eventually, as soon as we get this more sizable pullback at this point here, this is where I'd be labeling this up here as my M15 swing high now, okay? So now this is one big M15 swing pullback, and obviously we're looking for them price to go up here. So just so happens sometimes when this happens, when you get like a move that doesn't form a big swing pullback, we end up with a big swing range, okay? So technically this is our, just for the interest of making it clear, this is our weak M15 swing high, and this is our strong M15 swing low, okay? So let's start to build a narrative, okay? It's reasonably simple so far. In that, we got bearish M15 internal structure. Why? It turns bearish to facilitate the M15 swing pullback. We come into that extreme 4-hour internal demand, and then we get a nice big bullish move to the upside, giving us a bullish M15 break of structure. So now we have bullish M15 internal and bullish M15 swing, right? They are aligned. That confirms to us that this swing pullback is over. So now what is our expectation? Our expectation is that the bullish M15 internal structure will remain bullish until it takes out that high. That's the primary framework that we always follow, right? So this high has led to a break of that high there. Sorry, this low has led to a break of that high. Therefore, this is a strong low. We expect price to pull back, but not to break it. And then we expect a target of this week high. This then becomes a strong low, right? So on and so forth. You should be very, very comfortable with that. So longs now are phase A, and ideally that's what we want to be focusing on because the 4 hours bullish, we've mitigated that demand. We're expecting price to target this week M15 high, right? We have the bullish M15 internal structure. Longs are definitely the more probable scenario. The reason, I'm just going to delete this just to make it a bit more clearer. The reason why this is a bit more ugly and tricky is if you look at the immediate price action, although we know this is our weekend 15 internal high that we want to target, and this is our internal low, if we look at the immediate price action that's in front of us, which I'll zoom into in a minute, it's not as clear. So even though the large internal structure, we know the directional bias, if we actually zoom into this bit, it's like, okay, well, does it make sense for me to look for longs right now? And where do I get long? Because if you actually just kind of, if you draw a box around it, like all of this is what I just call range bound price action, right? This low here has not broken any significant structure to the left. And by significant, I mean like the top of this leg, right? It hasn't broken that internal high, it's just caused a chock. Likewise, these highs failed to break this low, they've got broken. This high has failed to break this low. These are just kind of weak highs and weak lows either side. This is range bound price action. It doesn't really give me a very, very clear directional bias at this point. But overall, we are obviously more bullish than bearish. Hopefully I've explained as to why. So when price action is like this is where I would exercise caution. You probably found this in your backtesting the live market, not to try and force trades in here. Okay, you might be able to catch this short from the supply. Maybe looking from longs in this demand, you get stopped out. Maybe you were trying to short from here at this point when it pulled back in. Maybe you're trying to long from here. Maybe you caught it, maybe you didn't. It's not very clear. Whereas when you compare it to like here, right, directional bias is clear. Just we want to buy, we want to buy, we want to buy. Or at least the directional bias is clearly long, don't necessarily have to trade it, okay? Bearish IBOS, okay, now we clearly want to be looking for shorts from these strong highs, right? Structure is very, very clear. There's no if, buts, or maybes. We want to be shorting from this high, targeting the weak low, okay? This immediate price action, this is where I see a lot of inexperienced people unfortunately get caught out here. Look, I'm not having a go, it's understandable. Like we all get caught out in these environments where it can look a bit clear and then sometimes it takes a little while before we realize actually we are just range bound. I'm just trying to make the point that this is a bit messy. So, well, what do you do? Well, this is where I say just wait for a little bit more, okay? So if I play price forward a little bit to here, now I would say you've got a bit more going for the bullish scenario, right? Because if we look left, there's no unmitigated supply for us to be concerned about. Okay, there's just this wick. This is not an unmitigated pivot level of supply. We have taken liquidity here and we move to the upside. And you're starting to see now price just continuously making those higher highs and higher lows. I know we break that low there, but overall, we're starting to form much more bullish order flow. We've swept liquidity. There's no supply to the left. Overall, the reason why we can have a bit more confidence with trading the market ugly is because of where we're coming off. Remember, into the 4-hour demand, bullish change of character. We've mitigated this 4-hour demand. The path of least resistance is to the upside. The M15 internal and swing are aligned bullish. This immediate price action is very, very tricky to trade, so let me try and stay away. But now at this point, I'll be like, okay, maybe now I'm ready to get involved because it's looking a hell of a lot more bullish than bearish at this point, right? So if you want to look for a POI within this leg, this extreme POI is obviously mitigated, right? It's already had a movement in that pull back. Then we got this level here. Okay, that's kind of already had a mitigation. Arguably it's sufficient price action, but it's very nearby, so we can just adjust it to this level here, and we can look for price to get involved. So obviously, before we even jump down to the model, this is a little bit more messy than the other examples we've been looking at. But why now, if I'm happy to trade this directional bias from this POI, basically viewing this as just one strong leg, right? This broke this high. Why would I be thinking about LC1? Well, it's pretty much because I'm basically playing this internal of the internal range. I'm just looking at this leg of price action. I'm looking for price to come back in here and trying to capture a quick move. So you see, again, it's the common theme of it must be a tight range that you were looking at. I'm looking at this one leg and I'm looking for price to come in. Because for my trade idea to be valid, really this low needs to hold and we're expecting that move to go, okay? So obviously I can still wait for I'll be looking for LC2A as well. But if we get a liquidation of this lid into our POI mitigation, then that's what I'm going to be, looking to get involved with. So price pulls back and now our alert will go off. Step 1, POI mitigation. Yes. Step 2, do we have a strong liquidation in the pullback? Well, did any of these lows break highs? No. That low didn't break a high. That low didn't break a high. So there's no strong liquidation in the pullback. Okay, but because it's a tight internal range, I'm allowed to look for lid to the left. Just take the nearest and most relevant one, right, to your POI mitigation. There's a liquidation of it. So there we go. You can enter above this liquidation candle here. Okay, 2 pip stop loss buffer takes us nicely behind the POI. Now, with this, not ideal that we can't get our target to the internal high. I do much prefer that, but you have to then ask yourself if you're happy to take it. Well, does it make sense? Do we expect price to go higher? Yes, because ultimately we're expecting price to take out this high. So it's up to you, whether you want to trade it. My best trades are when I can get the profit target here, because when we break that, obviously we're expecting a bit of a deeper pullback. So we want to be able to ride that out. But you'll find a lot of times, we've got everything aligned phase A, it's just going to keep going, and you can target past that internal high, right? We obviously have plenty of risk reward up towards the swing high there. What happens with the next candle? We have an inside bar, so we do nothing. We leave our order on. Now price pushes lower. Okay, so this one, it actually pushed lower, so it broke the low first and then it went up. So the very, very second it breaks that low, you cancel your order and then you wait. When this candle finishes printing, is the POI still respected? Yes, therefore the trade idea is still valid. Okay, so now we can enter on this candle. Now, another thing as well, this is when you can use a little bit of common sense. I mean, in this case, there's a few things here, right? The first thing I was going to say is perhaps you're not 100% sure on this trade idea because this is a little bit uglier. This is a little bit more aggressive, right? I totally see that. But when you see this happen, like nice, big, bullish, strong body candle closure like that, literally completely mitigated the extreme, within this zone, like really fill up every order. Like if this POI is gonna work out, it's gonna have to be this candle, right? We're not gonna come lower and go again because the POI would fail. That gives me even more confidence to get involved, right? If you already were not maybe umming and ahhing a little bit about getting involved. The second thing I was gonna say, for the same reason, is that you might want to be a little bit more aggressive with your stop loss placement. Maybe you might go, well, we've literally tapped into the extreme of the POI, therefore I'll just give it a pip rather than thinking I need 2 pips. Okay, again, it's using a little bit of discretion, depends on how strict and super mechanical you want to be with always using the same pip buffer, because of course, price could do this, sweep the low and go, and you'll be in, but just something to think about. And there we go, right? There's a trade, it ends up playing out, it's a winner. So this for me is where you're trading the M15 a little bit uglier. But the reasons as to why I'd be happy to get involved is because everything else is kind of aligned and in favor of the trade, right? 4 hours bullish, like I said, we had the bullish stock. Very likely price is now going to target this high. Momentum strong overall. We came back into this 4 hour demand here. The reason as well why the market was a little bit choppy, as this was Thanksgiving price action, so US bank holiday, so it's understandable prices ranging. But then what we've seen coming into New York, we're starting to see that clear bullish order flow. Okay, we've got an immediate price action leg here. There's no supply left for price to contain price. Got a nice tight range, basically paying this internal leg, looking for price to come in. Okay, maybe you're not 100% sure. All right, here you go. There's your lid. Nice big bullish retrace candle as well in case you just wanted a little bit more. If I saw that, okay, I've got confidence now to take the trade. And there we go. So not the best trade in the world, but that'd be a phase A trade. Let me just see if I can flip this for a second. Okay, basically trading in either of these 2 phase A's here. And that would be that. Alrighty, so let's take a look at some phase C trades with LC1. Now, by now you should be very comfortable with, when we should be using these phases and how they all work. But phase C is when we are trading counter swing. So if we're getting long, right, we're trading against the bearish swing structure, but we are trading pro internal. So phase C, just like phase A, is generally a decent phase you want to be trading. Usually those trades are medium to high probability. They are when I am almost always considering looking to take a trade. The most simple reason as to why you can remember it in your mind is because both of those phases are pro your medium time frame internal structure. So the reason why that's generally higher probability is because you're trading in line with the immediate price action, right? Those immediate ranges, you're trading in line with that far more often than not. So generally on the right side of the market. Okay, so a typical way in which we want to trade phase C, obviously it's not going to look like this in every single scenario, but we want to stack as much confidence on our side is after we've had that break of structure, we get that first initial bullish IBOS here. Now this is great to trade phase C because it's the start of the pullback, right? We're playing that objective. Phase C, pro internal, counter swing. We want to be playing the start of that pullback when risk reward is on our side. We're buying in a discount, plenty of room to target up to premium prices after that first initial IBOS. That's it in its most simple terms. Of course, there's other things we can add to it, such as, are we coming off a higher time frame, zone? Is this backed up by the immediate high time frame directional bias too. Do we have a strong liquidation as well in the M15, kind of giving further confluence that potentially we are ready? Because sometimes, as you'll see in the live market, you'll get an initial bullish IBOS, and then we'll look to take phase C, but sometimes it's a trap. Sometimes we then come lower before we go. So if we can see a strong liquidation and into a significant level of demand, that's going to increase the probability that this bullish IBOS isn't a full signal, right? But anyway, phase C is a good phase, so let's take a look at some trades. So 4 hour chart here, this example is going to be the one that you would have first seen as the very first trade example I showed you with the LC1 content. However, I didn't go over the actual narrative building for that trade. I just went over the entry model. So here we're going to focus more on the narrative building, right? So 4 hour chart, we can see, just zooming out a little bit, we've had clear bullish structure for quite some time, and now we're gaining a lot of momentum. Of course, we can do some daily analysis as well, but I'm going to keep it somewhat simple for you guys, okay? This one arguably could have been viewed as a swing pullback. It's not quite as big relative to the recent pullbacks, here. So it's a bit of a debatable one, but it doesn't make a massive difference to your overall directional bias, particularly when we're dropping down to the M5 for an entry, right? So after a break of this structure here, we've had a reasonably overextended run, bearish 4 hour change of character, and then we're seeing these nice big strong 4 hour bearish candles, right, really showing that momentum coming in to look to play the pullback to at least this level of 4 hour demand, right? So clear, bearish order flow starting to form. We even have some 4 hour minor supply here that broke the low, haven't drawn it on, but yeah, that would be a valid 4 hour supply zone. So let's just draw on, right? Stop being lazy, okay? But very simple trade idea, hopefully you can see already, is yes, the 4 hours bullish, but this is a good opportunity to play the pullback, right? If we look left, there's no significant demand here for us to worry about really until sort of this level down here, okay? So 4 hours giving us a short-term bearish directional bias. Now, if I zoom out a little bit on the M15, if you can remember from that example, this was an M15 swing pullback here. We then got a swing break of structure. We did pull back and break the low, but it failed to close below the low, which means it's not a bearish boss. Remember, we need a candle body break for a swing break of structure. So it ends up just being a liquidity grab, and then we got another bullish M15 break of structure there. Since we had that bullish break of structure, none of these pullbacks were that significant in terms of size. They were all just internal pullbacks, which means we keep our swing low down here, okay? And this gives us our current swing range once we have that significant pullback. So 4 hour and M15 swing are both bullish, but the M15 internal structure is now clearly bearish, right? So that's a very good signal that we're now playing what? We're playing the M15 swing pullback, at least down and towards this 4 hour demand. Nice and simple directional bias for the session, okay? And then we zoom in even more, and what we can see is this is our current M15 internal range that we are working within. So our immediate directional bias is clearly going to be bearish. We're going to be looking for shorts within this internal range, right? Between these two red lines. If we are taking shorts, that means we are trading pro internal trend, but we are counter the bullish swing trend, okay? Which means we are phase C, right? I can flip this diagram to kind of help you visualize that. Essentially, we are trading this, okay? But obviously in this example, we're a little bit lower down. So we're more around here, okay? That's what we're trading. We're trading phase C. Now, directional bias is sorted. So the first thing you do is you've got your directional bias, you know your range, okay? So if you know you want to get short, how do we do that? Well, the second step is to identify the areas of interest, your POIs, your points of interest, of where we can play that directional bias. So we can see that extreme supply zone has already had a very clear mitigation. So then this is going to be the next supply zone we are looking at. Now, straight away, remember what I'm always saying to you is your mind, 90% of the time, if not more, should just be thinking about, I'm just waiting for a strong liquidation in the pullback. I'm just waiting for LC2A. Keep it simple. Again, 90% of the time, just be thinking that. In specific scenarios like this, you can think about trading LC1, right? And let's go through the list. A high probability and higher end of medium scenario. Well, the fact that we are in phase C already puts us in, medium to high probability in most occasions, of course. Just being in a certain phase doesn't on its own make it medium to high probability. It needs to, of course, have other confluence, but generally if you're in phase C, it's going to be generally a decent trade in most scenarios. What makes this also good is the momentum, like big, strong momentum. No significant higher time frame demand. Yes, there's some small M15 demand zones within here, but when you've got such a big range like this, and we start to sell off with strong momentum, this is literally where I pretty much ignore all of these. Like, they might give small reactions to play pullbacks. I'm not interested in that. I'm looking now for price to generally make its way down towards a significant level. Okay, so again, this is making shorts high probability. But what's the other key thing for LC1? The key thing is that the internal range we're looking at is a tight / small MTF range, right? That internal range. You can see the lower time frame lid and the lower time frame entry on your screen at the same time without zooming out. Before I even drop down, I know that I'm going to be able to see that, right? Now, yes, we're allowed to use lower time frame lid, but straight away I can see that we've got clear MTF lid here, right? So we've had our POI mitigation. Like I said as well in that first video, you can also be looking at this as your POI too. That's totally valid, right? So let's jump down to our lower time frames. So if we're looking to trade that first POI, we have our mitigation. Do we have a strong liquidation? Well, nothing has formed in the pullback. Okay, none of these highs broke any lows to the left. They're all weak highs, but this is where we're allowed to think about LC1. So take the most nearest level of lid, right? This is a structural high. There we go. Okay, so far it hasn't given an entry because since the mitigation, none of these lows have broken, but now we could place our stop order below this low here, right? This is where the lid liquidation occurred. We get our POI mitigation here. This would have been the first candle. We could put a sell stop below, but prices pushed up higher. So now we have our sell stop below here and whatever buffer you want to use. Now we have an inside bar, so we don't do anything. We leave our stop loss open, our entry on. Another one, just leave our entry on. Now price pushes up higher, so we cancel our entry order. This POI has now failed. So that trade idea is no longer valid, but as we said, right, we've still got this extreme POI, so this is one we can use. And we have nice, clear medium time frame lids. We're pushing deeper up into the extreme, which of course is going to add further confluence. This is even looking better now if you want to trade this idea coming into the strong internal high. So let's have a look. Okay, liquidation of this lid. The PBL clearly has not been mitigated and made a new high, right? It hasn't even been touched, even if you take that wholesale to buy, right? This is completely unmitigated. Therefore, the trade idea is valid. Okay, sell stop below the low. Let's say we're using a 2-pip buffer, 6.5. Okay. And then let's just say we use kind of the crude analysis of 3.3R to get rough net R. That's an inside bar, so we leave our order on. Okay, pushes up a little bit higher, cancel the order. POI is still respected, right? We haven't traded higher, so we can set your entry order in here. And then eventually we get tagged into the trade, and there we go. So I went over this entry model in a lot of depth in the very first LC1 walkthrough video, so watch that if you're a little bit unsure on any of this. But really, the narrative building is kind of the main lesson I want you to take away from this. A lot of you who've been here a while will know that when I see this type of scenario, okay, where we get a big overextended swing range like this, we've had a clear bearish eyeballs to downside, a lot of momentum, and we're forming these nice small internal ranges. There's nothing significant here to the left. Yeah, there's some demand, but whatever, I don't care about that. Like, it's very likely price is going to make its way through, and this is where you see those strong momentum until we get to these levels. So when I see this is where I want to be as aggressive within reason, within my plan as I can to get involved. Okay, I have very, very high conviction that this high is going to hold when price is pulling back. Now, exactly where that lower high will form, I don't know. But the nearer we get to that high, the nearer we're coming in here, I'm almost just looking for an excuse to get involved. Like, this is when you can consider even just taking a risk entry, right? And whatever. So these are the types of environments I'm going to have to try and just impress upon you as hard as I possibly can of only when you should really be thinking about LC1, at least to begin with, because this is when I'm going to try and be as patient to wait for these environments to even think about LC1, because LC1 is going to happen everywhere and almost every single session, every day, multiple times a day, and you're going to get burnt a lot. Like I'm going to keep saying, you're going to get sick of hearing me saying it, but I'm going to have to keep saying it because I am very concerned that I'm going to see all sorts of bandits in the Discord with less experienced traders just taking it because they feel that if they see the entry model, therefore they must take the trade, which of course, as you're more experienced, that is the furthest thing from the truth. But this is a almost perfect example. I couldn't almost find a better example of when I personally will be considering LC1. Okay? Literally come up into the extreme of this POI. There's nowhere else for price to go at this point. Like, even if you're still doubting whether you should take LC1, at this point here, when price pushes all the way up to here, there's no room for an LC2A to form now, because if we get the bearish chalk and we get the fake break, for price to come up and liquidate that high, the POI would have failed, and technically that's not a valid entry. So really, there's no other ways for me to now get involved other than LC1, especially if you see price and start coming down. Like, do you know what I mean? I'm going to take that all day long. Okay? So yeah, very, very clean phase C. Nice big overextended swing range. When you get this price action, price starts selling off with momentum. This is go time for me to get involved with those phase C trades. Alrighty, so let's take a look at another LC1 example, which is a phase C trade. So for our chart, we can see that we have started to form a bullish swing trend with 2 breaks of structure to the upside. Yeah, not really too much else to say from that in terms of a structural perspective. And we are currently in the 4-hour swing pullback phase, right? After the boss starting to sell off with some decent momentum. Now, price has come into a level of 4-hour demand. It's a decent level of 4-hour demand. It caused a previous break of structure. So there is actually a decent probability, right, that price could continue the bullish swing trend from here. However, we do have cause for lower prices with some more well-priced levels of demand within the swing range. So that's something you have to bear in mind, okay? Now, when we jump down to the M15 time frame, this has been the medium time frame that I'm using in order to shape my directional bias for the session and to pick the POIs in which I'm going to trade that directional bias. The swing trend on here is also bullish because this was where the last swing pullback was that then led to, it's actually like this, it's a bit of a weird one, that then leads to this movement here. Now, this wasn't a sizable pullback relative to recent price action, so these are just internal pullbacks, okay? And then we have that convincing IBOS, and then we literally almost just sell off in a straight line. Now, yes, if we go back to the 4-hour chart, this is a bit of a trickier example. This is where we come into demand, like I keep saying, we could expect that movement to the upside. We do have to be aware of that. The M15 swing is also still bullish, so there's every possibility we could be heading here to the upside. But with the strong momentum to the downside, almost impulsive, we're only kind of putting back quite correctively so far, right? We don't have like a bullish IBOS to the upside to confirm that this swing pullback is over. There's all of these kind of relatively equal lows to target with sell side liquidity. And if we get that deeper 4-hour pullback, okay, this is the 4-hour swing low, right? Again, there's a lot of cause for lower prices before potentially continuing that movement. So this is one of those scenarios in which you can have a little bit of a, conflicting directional bias. But this is where, and this was, if you look back on our markups and analysis in the live market in the Discord, we were looking for quick shorts because with the current structure that we have to work with the immediate price action, we were looking for another continuation of that move with just how impulsive this is and with all of this liquidity here to target, okay? So it's not the most high probable scenario in the world because you have that conflicting directional bias, but hopefully you can see as to how we can build the picture a little bit when we don't have, if you always want to wait when everything is perfectly aligned, then you can be waiting for a long time. There's nothing wrong with that, but that's not personally how, I want to be trading personally, okay? So nice impulsive move to the downside. This is then our weak internal low. The other thing that's nice about this is the sort of corrective pullback so far, right? Just stacking these corrective lows where we know there'll be a lot of liquidity, typically for price to target, right? How does price usually move? Impulse, correction, impulse. And that's how it's starting to shape up. Now, this is just before Frankfurt Open, about an hour or so before. So let's just kind of play price action forward from here. Now, this is a little bit subtle, but we do actually have a bearish M15 change of character here. Okay, it's not the most of obvious ones in the world, but if we're mechanical, what does that mean? It means we have an M15 fractal high that broke an M15 fractal low, therefore it meets our minimum criteria as a strong high. So now we're potentially having this M15 strong liquidation into our POI mitigation. Now, if you were to drop down to the M5, technically this would be an M5 LC2A entry, right? Because it's also, that immediate price action in the pullback to the POI. We have that fake break liquidation here, and that technically would be an LC2A entry. The reason why it's not valid for me is because this is an hour before my session opens, so it doesn't have that session timing, okay? So we pull back into this M15 POI, potentially we're having this M15 strong liquidation. Let's see what happens next. Okay, perfect, right? If you're not really too sure, about your directional bias or whether we're about to push up or whatever, and we start seeing supply fail, then okay, we'll probably start thinking about longs. But the fact that we pulled into here, it's a bit small to see, but we have had that M15 strong liquidation. Nice V-shaped reaction, right? 3 strong bearish candle closes. That's then given us another bearish M15 change of character, a bit more of a convincing one than the one we were just looking at as well. Okay, so now it's go time for us to look for potential shorts from this level, right? We've had a nice convincing pullback into here. So technically, even this short would be phase C because it's pro internal counter swing. But what's even better about this is we have that immediate fractal order flow now shift in our favor. Right, it's not like we're trying to time the pullback here. We've now got the immediate fractal price action on our side as well, confirming this level. So now shorts are phase C and pro the fractal structure. A lot of, things aligning for us now coming into session timing. Yes, there's a little bit of demand here, but these are all these corrective lows, right? Now the pullback is likely over into our POI, strong liquidation, V-shaped reaction. If we can get a short from within here, this is very much where you can then target that week low, or you don't even have to do that. You can look just for your quick fixed hour target and try and get in and out even before here, potentially depending on how that lines up. Okay, so that's the trade idea. Let's wait for our POI mitigation. So price starts to pull back a little bit and it pushes down, okay? And now we start to pull back up. So I'm gonna obviously jump down a little bit just so we can do that in slow time on a lower time frame to see what forms. Now, common mistake, and I totally get why, is say, at this point where we get the initial M15 shock and prices here, at this point, we do have a valid level of supply. Now, as price is pulling back up, obviously we can look for the fake break to occur in the pullback where we want to look for a high that breaks a low, and then we look for the liquidation of that high, right? And then we enter. Now, it looks like that was starting to form here, right? We're starting to get price action in the pullback, and then this high does what? It leads to a break of a low. So then the question is, okay, if price pulls back up, is that then our fake break liquidation for an LC2A? The reason why it isn't, and the reason why we don't classify it as that, is because when this continues to move, if you look back at the M15, this is going to help you to keep it mechanical. This is now all part of the M15 leg, right? Initially, it would have been a pullback, right? If I bring it back a candle, if price action was here, right, and on a lower time frame it pulled back, then it gave the fake break, and that high breaking that low doesn't come all the way down here, right? It just breaks in and then it comes up and then we get the liquidation, that little cross being the liquidation. That would be valid LC2A. Why? Because this is all that medium time frame pullback, okay? And that was starting to set up. But then the key thing is that pullback then breaks the M15 low. So now this for me is kind of a mechanical way in which you can say, okay, this is all part of the M15 leg to the downside. So what this is actually now is this becomes lid. This is M15 lid, it's leg inducement. This is part of the M15 leg. So if you are looking or trying to define what now would be the LC2A, it would need to form in this pullback here. So this is now our M15 lid, and of course it's lower time frame lid as well. So I just want to go over kind of the classification of that in case some of you are confused. So now what we get is we get our POI mitigation. Okay, of course you can look for the LC2A, but you need to look from where the pullback starts. And here, there's clearly no high has broken a low within this red circle within the pullback. So if you want to trade this here, what's your option? You can use the lid to the left, okay? And this is how you would set this up. So I think you all understand what the entry model pretty much looks like by now. I think that should be clear. The real purpose of all of these examples is, again, to really drill into your mind when you should be thinking about this entry model. So I'll come back to this in a minute and let's talk about the M15 a little bit again. All right, strong momentum. We've come into our POI, nice corrective lows to target, strong liquidation into here. The fractal structure is now on our side. We've got medium time frame lid, but look at the range we're playing. Because yes, technically, this is kind of that's the last eyeballs there. I mean, arguably you could call that an internal pullback. But, either way, that's kind of the larger phase C range we're playing within. But within that, what do we then have? We have a confirmation of the level, and now really we're playing this range. It's this tight little range because like if this supply fails, then really we're probably going a lot higher, right? This is already mitigated. This zone here, like really if this fails, probably trade idea kind of over. So this is kind of like, when I see this, I know that this is the POI, which I'm happy, very, very happy to take a loss in because this is the one that's going to go if my trade idea is right. So this is what we're talking about, being super, super aggressive, very, very tight, immediate little range to work with, only one POI to look at, medium time frame lid. Like this is like when you can consider taking a risk entry, right? This is literally where you don't even have to wait for an entry order if you want to have this in your plan and you can take a risk entry like that. Okay, and that's why we take it. And again, coming back to here, high probable to medium, higher end of medium scenarios, tight, small range, okay? Or a scenario when you consider taking a risk entry. This is when we want to be doing it. Perfect example, okay? So that's how you would size a trade up. Now, what isn't ideal is that the target would be just past the low, but more often than not, you're going to probably hit your target just past there and then you're out, okay? So very, very clean trade. Yeah, I think the entry model hopefully makes sense. That was a nice example to cover the difference between when it's LC2A and when it's LC1, and kind of the mechanical way you can define that is if when we start to get that pullback, when that high finally breaks structure, if it breaks the medium time frame low as well, then that's just a continuation of the M15 leg. That is all now lid, and you want to see the pullback form the fake break if you're looking for LC2A, okay? So we can still use this. This is still a valid strong liquidation because it's a high that broke a low. We can now trade it now that we have this additional entry model, but we just classify it as lid, Okay, so if you're going to do it, you still want to do it in these scenarios where you have very tight range. There's nowhere else for price to go. This is the POI we just want to get involved with, and this is your aggressive way of getting involved. Alrighty, so let's look at another phase C LC1 trade. Okay, so I think we can all clearly see that the 4-hour chart has shifted bullish, so we can keep our analysis reasonably simple. And without even looking at the M15, we can see that we're starting to play that 4-hour swing pullback with nice risk reward down into demand before potentially the continuation of that swing trend. And what else do we have? We do actually have 4-hour structural confirmation where we get a bearish 4-hour change of character, giving us a nice tidy 4-hour level of supply, right, to look for potential shorts from. So building the narrative on the 4-hour chart is pretty simple, looking for that immediate bearish bias to play the 4-hour swing pullback. And as usual, TradingView likes to not show my zones where they should show on the lower time frames. But anyway, we jump down to the M15. So if I zoom out a little bit for you, I've done some preparation. Okay, and we can see that we shifted bullish here, had a bit of a pullback, and then we are still bullish because this is just an internal pullback. Okay, so in this occasion, I've left my swing low down here. Now, obviously after an M15 boss and a 4-hour boss, what do we expect? We expect swing pullbacks on that time frame. Of course, we can try and get in early and time those pullbacks with phase D trades. But what have we been trying our hardest to push you guys towards? We've been trying to push you towards waiting for phase C before taking those shorts. Okay, so for instance, momentum is strong. We get another bullish IBOS. You could be looking for phase A2 trades in here. We haven't really spoken too much about that. These are really what they can play out. They can occur, especially when the market is trending super well. But a lot of the more times you're going to get burnt trying to take longs in here. Okay, especially when you can recognize that this is often what price action sets up before we get that reversal, because yes, it's an internal pullback with a bullish IBOS, but what is it also likely going to be? Big liquidation of Asia equal highs to then get the bearish IBOS to then get a big powerful swing reversal. So this is why until you're consistent, and even when you are consistent, I would push you away from not worrying about A2 for the most part, because in most occasions it's going to be pretty tricky to trade. We also then get all this messing around if you're trying to trade phase D, like because there's a chalk you could try and short within the supply. Look at this. Wait a day or two, whatever it takes, not even a day. Bearish IBOS, nice momentum, clear POI to look to trade from, 4-hour supply and a 4-hour bearish chalk to back it up. It's just like you don't even need to think about your directional bias when you see this, right? These are the types of environments, in general, I try to wait for, where it's so obvious what needs to be done. But particularly if you're going to be considering trading LC1, right? So we've got two POIs here. This one and the extreme. Of course, the extreme is always going to be higher probability because it's well priced, and we can use this as medium time frame lid, right? There's no lid in this leg on this time frame, so very often these are inducing moves that can fail, particularly when this was likely caused by news, right? With that volatility, very often those moves can be retraced. The high gets liquidated, and there we go. So do be wary of that. Let's see if we get any strong liquidations that form in the pullback with the fake break. Right, we're just looking at what formed in the pullback. No high here, breaks a low so far. That high doesn't break a low, and then the POI fails, so that's not too confusing. Surprising would be the word I would use. So now we're coming into this extreme POI. It's a high probable scenario. It's the start of phase C. It's a very tight range. Again, remember that's a key thing. What's the range we're working within? We're working within here. All right, we've got clear medium time frame lid to the left. Obviously, we're going to be able to see that on a lower time frame, well within where our entry is forming, right? We're not going to need to zoom out. This is ticking all of the boxes for trading this entry model. The other thing as well, I love this, right? Big swing range. There's no immediate POIs here that I'm concerned about, right? Not really until price comes down towards this region. It's like I view this almost as like a vacuum in price. This is go time to look for these movements to come to the downside. Okay. So get our POI mitigation. We have our clear liquidation of lid to the left. Like all of this lid is valid as well, but right, you don't need to draw them all on, just draw on the nearest one. Both, they're all valid, okay? And then obviously we've got a POI mitigation, sell stop below the low. Let's lose a 2-pip buffer, so 7.3, okay? I mean, you could even go bigger if you wanted, because obviously there's plenty of risk to reward here. Then we get tied into the trades, and there we go. Nice, simple, easy trade. Okay, obviously you guys, you can hold trades for a lot longer if you want, but my recommendation is just use fixed R. get some wins on the board, get your confidence up with your own ability and the strategy, and then you can start thinking about being a bit more advanced with bigger targets in certain scenarios when you've earned the right to know when and when not to do that. Okay, the main point of this little series of videos, I guess you could call it, is very specific scenarios. Generally, the start of phase A and phase C, momentum's on your side, tight internal range, clear POI. There's only one or two to pick from. There's no significant demand that we're worried about prices coming off. Nice risk reward on the side. These environments do not happen every day or necessarily even week, but when you see this, go time to think about OC1 and just aggressively almost try and get involved. Like if I took a loss here, I'm not worried. I'm not going to beat myself up. Whereas if I take a loss trying to buy in here or trying to force a phase D short in here, that's when I get annoyed at myself because I wasn't patient enough. Again, not saying you should never trade phase A2, not saying you should never trade phase B, not saying you should never trade phase D. It's just generally, if you can wait for those starts of phase A and phase C, they're the times when you want to be thinking about OC1. They're the times when you want to be more aggressive in general, just to try and get involved. And also, if you trade more than one pair, then you can maybe find it a bit easier to be patient to wait for those certain phases. All right, so just some food for thought. So let's take a look at the statistics for the LC1 entry model, and we'll also go through the statistics for LC2A with those two combined, right? So as if you were trading them both within your trade plan. So how we're gonna go through the data in this is we'll just quickly recap the sort of basic, high level trade plan rules that I used. We'll then look at just the stats for LC1 on its own. So by raw data, we're just going to look at kind of, including those low probable trades as well. Then we're going to look at the LC1 data by removing those low probability trades to kind of try and show what, that great potential if you can try and reduce as many low probability trades as possible. And then we'll look at the summary stats, typo there, but the summary stats of both of those entry models combined to give you an indication of sort of what to expect if you just traded those two entry models in your trade plan alone. And then at the end, we're going to discuss around how you could potentially try and improve those results yourself with some tweaks to the trade plan rules. So same as LC2A, you guys should know 4 hour as your higher time frame. I use the M15 as my medium time frame, so that's the main time frame. The M15 is where I'm using, my directional bias, and I'm trading from those M15 POIs. Okay, so you must wait for an M15 POI mitigation, and then I look for the entry model on the M5 playing that M15 POI. Okay, obviously the LC1 entry model, you guys should now be very familiar with that, using that lower time frame led to the left in very specific scenarios. Fixed R target, similar to LC2A, as I did the back test, I just used a spreadsheet to allow it to show me what the most optimal target is, giving us that that fixed R target of 3.3R. So in reality, in the live market, that's a crude way of trying to give us a net 3R when we actually take into commissions that will get charged on a live account. This time I only tested between 7 a.m. UK time and 4 p.m. So I did an hour less because I just realized there's no point there wasn't really that many trades, and the strike rate was a lot lower after 4 p.m. UK time. And another big caveat to this is that the data includes just basically trading through high impact news. Okay, so this is definitely something you'll have to bear in mind with your actual live trading, of course, that you'll close trades early, or you might not even take them if it's in or around that high impact news. And this data is solely on euro dollar from the start of 2023 to year to date, which basically means I've now included from January 1st to the end of November. Okay, so just December is missing from this data. Big disclaimer, gone through this before, but it's super important that you really take heed of this and take note of this before we look at the stats. And that is backtest results are obviously not live results. Okay, we have to deal with real stuff of the market, spread, slippage, commission, swaps. They are all going to generally have a negative impact on your real results. Psychological errors are a massive one. Okay, there's absolutely, my personal live trading is never going to be like my backtest results, right? I'm going to talk myself out of trades. I'm going to talk myself into low probability trades. I'm going to make errors. It happens. Real life gets in the way. I'm going to go and take time off from the markets. I'm going to go on holidays. I'm not going to trade when I'm away. There's going to be a ton of time I'm going to miss from live execution. I've got real life commitments that get in the way. So again, You're not going to hit every trade, and that's okay. You don't need to. Hindsight bias as well, it's something that can't be ignored. I'm very familiar with euro dollar price action. This is the data that I backtested with this. That is going to be baked into it for sure. But of course, you've seen that we have tried to make the strategy as systematic as possible. So, I still have a lot of faith and trust in the robustness of this backtesting data. Okay, but live data, how you actually execute the strategy, is ultimately what matters. But as we'll go through this data, and as I spoke about before throughout the LC2A module, the lessons in there, that I've tested it by taking what I deem to be low probability trades. There's a very high trade frequency here, so I know that carrying this over into live market, especially with the forward testing we've done, it will be fine. I will still be more than profitable. It's just that I'm not necessarily expecting to hit what is showing in the backtesting data. Okay, so you want to have a healthy sense of realism. Still being optimistic, okay, you don't want to be super pessimistic, but you need to have some realism in that backtesting results are not live results. Okay, I know it sounds obvious, but I don't know, there's a lot of naivety that can go around in the trading space, and you have to be very cognizant of that fact. And again, I'm going to keep saying it until you guys are absolutely sick of hearing me saying it, but you must focus on the medium time frame narrative and the medium time frame POI selection. Okay, it's not the entry model, it's the medium time frame narrative and the medium time frame POI selection. That is the most important thing about this strategy, even more so with this entry model, particularly the LC1. Okay, the LC1, it's going to take you some time to master this. It's a much, much harder strategy to know when and when not to execute it. Okay, let's dive into the data. So like I said, first we're going to go through all of the LC1 trade data on its own, where I've basically taken a lot of low probable trades in there as well. So from January to the end of November 2023 on euro dollar, using the LC1 on the M5, that is suggesting a net return of 70R. Obviously, you need to take in commissions. So we've been targeting 3.3 to try and do a crude way of that. So if we say that, that extra 0.3 is basically going to be removed on all of our winning trades to account for commissions, then that very roughly gives us 58R. Okay. Now these stats here, they haven't removed that 0.3 because it was just going to make the formulas too complicated. It was a bit too long. So you kind of have to reduce these stats in your head a little bit. Okay. And now we can see, so strike rate is really not amazing if you're including those low probability trades. Now, if you have not skipped ahead of the lessons and you have watched, all of those lessons where I'm saying when we should and shouldn't be hitting it, you can remove mainly when the strategy is not worth using, which is A2, right? Trying to keep buying or selling after the medium time frame swing break of structure, trying to trade phase D, okay, when you just counter everything, trying to trade in ranges. Okay, if you remove that, as we'll see in a minute, it's really, really going to help this. But this is just to kind of show that even if you take low probability trades, you might be okay, but I don't really want to encourage that whatsoever, because the reality is you're going to be in bigger drawdowns. Who's to say you're going to keep being aggressive when you need to be to then actually take advantage of the winning trades? Being aggressive sounds great on paper when you look back at the stats here, but in reality, it's very, very rare that you're going to do well if you keep taking low probability trades. So, if we remove those low probable trades, there we go, reset that. The strike rate is much more what you should be aiming for, in my opinion, getting that strike rate above 50%, as much as possible. So the big difference between here and the previous one is actually the total R is not too much the difference, but here we have 65 losses and we can reduce that down to around 24. Okay, so the big thing about this, like I've been trying to say, is with LC1, it's like a little bonus model, entry model. You only want to be using it in very, very specific scenarios. LC2A, waiting for the fake break and the pullback, is what you want to be thinking for 80-90% of the time. Now, the big difference between here and including the low probability trades is we have taken away a lot of low probable trades from A2. Okay, so over here, you can see, we go back to here. So this is with the low probability trades. There was a lot of A2 trades here. Now, the reason why it's basically break even. But the reason why this ends up being probably break even rather than just completely in the red is I think there was one good period in July, I think it was July, where like euro dollar just literally flew to the moon. It just was so bullish, and aggressively trading A2 with really, really poorly priced trades, it worked quite well for about 3, 4, 5 trades in a row. But if you do that in most occasions, you're going to get burned. And who's to say you're not on holiday during July? Who's to say those trades, those trades could have been during New York and you only trade London? and then you don't take advantage of when, the one time that aggressive entry model played out, you're going to be in drawdown. So that's why for me, I'm happy to just really leave that alone, apart from very, very rare circumstances where, maybe I'll have the confidence to take it. But generally that's why I'm pushing you towards just A, B, and really C. Okay, so staying away from A2, D, and range, they're going to be really what I would advise. Okay, so A and C for the most part, and then we want to trade B when it's coming into the extreme POI, right, in which we're expecting the internal to reverse in our favor, right? We're expecting the swing pullback to end, and even ideally you can wait for like a medium time frame chock before you even want to take B, right? So that's basically our difference. So we've removed a load from A2, D, and range, and that's kind of really where you're upping that strike rate a lot higher towards 56. Now, do I expect to kind of hit this sort of return with LC1 in the live market? No, I'm going to be aiming towards that. But again, remember, as things stand, I only trade the London session. This includes both London and New York. I'm going to be on holiday. I'm going to be away. I'm going to be sick. I'm going to talk myself out of trades. I'm going to talk myself into low probability trades, okay? But this is just to give you a good kind of indication. If you kind of look between both, maybe we can try and aim somewhere in the middle. One other thing as well, my own personal trading, I'm much more likely to be conservative in the live market. That's just the way I am. I'm probably not going to take this many trades. But it's just to show you what the potential is here. So I guess the point I'm trying to make here is, look, I've clearly proven that the strategy is robust, particularly including those low probable trades, but these are just my stats. We've made the strategy as systematic as possible, but there is that room for sort of, let's say, 10 to 20% of discretion. It takes a lot of time to build the experience to know with how to build a narrative, how to do POI selection. Okay, it is a much more advanced strategy than potentially other strategies out there. So take my results as kind of just a rough roadmap of what is potential out there, but like really it's your stats that matter. Okay, they are really what it comes down to, of what you can do and how you apply these rule sets to the market. So I don't feel like I'm explaining myself very well here, but like, don't just see these stats and go, right, now I'm going to execute that next year or whenever you're trading in the market, and it's just going to be just like this, because it's not the case. Market's going to vary. It's going to vary year to year. Like some of these months are barely break even whilst trading both sessions with just this entry model. Okay, some months are really, really good and really, really strong. You need to get out of that kind of employee mindset of thinking it's going to be consistent returns every month. It's going to vary a lot. Okay, so I think you guys get the drill. You can obviously pause the video and dive into these stats as much as you want. But really, I've tried to make it clear in the previous lessons of how and when you should be thinking about executing this model, and then go and apply that to your own trading. Now, if we combine the two entry models, LC2A and LC1, just reset this a bit, it brings us to this. Now, again, caveat, these stats you're looking at now where it says this is including low probable setups as well for the two entry models and across New York and London. Okay, so this is if you're trading New York and London, both of the entry models, and just taking a lot of low probable trades as well. It doesn't include every single it doesn't include every single low probability trade there ever was, or I haven't taken the ridiculously low probable ones. There was just ones in there that I could see, even sometimes I would be tempted to hit because they kind of look okay in the moment, right? So this kind of gives you a rough indication of how you can trade there. I'm not personally expecting to hit 30R every month, right? It's a nice thing to aim for, but it just shows you the potential is there, right? So even if you don't hit that and you hit even a third of that, you're going to do okay. Some months might end up being negative, like June, whatever. But this gives me a lot of confidence. I know how robust this is, even with hitting some less ideal trades within there. Okay, again, you can dive into this in your own time. The breakdown is here. I'll just show you there as well. Monday wasn't that great, but yeah, there's not really anything massively interesting that I've really had the time to super dig into here. Again, it's the high level stats that I really care about, and then I'll dig more into the real niche stats more, and when I've got more and more live data, really, because that's what's important, what is important to me. And I'll show you here. Obviously, this would be super ideal if we can remove those low probable trades as much as possible. Then you can really get that strike rate above 50%, which is definitely what I'll be trying to optimize for. And yeah, don't get bogged down if you have a negative month here or there. It's totally normal. You've just got to focus on the bigger picture, get to that year end. And yeah, there we go. So as always, when you do your own data, just collect the trades during the hours that you can execute and you can be on the charts. And with the way that you like to trade, some of you are going to be more aggressive than others, etc., etc. Some of you might have slightly different rules with LC2A. You might use different management targets, all of that good stuff, right? So yeah, you can dive into that there, and then I'll kind of let you take a pause of this if it's useful. Okay. But yeah, this is kind of what I'd be looking to try and hit during London. June, probably terrible. Probably in reality, I'd miss a few trades. I'd probably have a negative month. It's totally fine. You still end up on a great year. The other thing as well is I haven't done the work yet, but I am looking to test this on pound dollar. So my idea at the moment is that I may be trading these two entry models, so LC1 and LC2A, alongside pound dollar. But I need to do my pound dollar testing, and we'll see how we go with that. Okay, so yeah. These two entry models combined obviously give you the trade frequency that so many of us, obviously prefer. It's much easier on your psychology to have that high trade frequency. But with that comes the responsibility to make sure that you are just not taking multiple trades a day. Because if you're doing that, you are most likely overtrading. You're most likely going to get yourself in a lot of sticky situations if you don't have the experience to know when and when not to hit it. Okay. But yeah, this is good. Take this away, do your own testing, do the work. Don't just jump into live market and start hitting this because, Matt's done the testing, looks good for Matt. Like, I'm extremely experienced. There's no hiding away from it. I've been in the market for, I think, over eight years now, right? I've done insane amounts of work. I'm staring at the charts. I'm at my desk for 10 hours a day. I do this full time. This is a full-time gig. So for those of you who've been here a year or two, couple of months, whatever, it takes time to get to a level in which you really, really know what you're doing, okay? But yeah, let's talk about how we can potentially even, improve these results even further. So if you paid attention and you watched the statistics video from the LC2A module before this, you will see that these are all the same points apart from the last two, okay? But they're still extremely relevant. If you want to improve your results, particularly in the live market, the most important thing you can do is improve your skill on building that medium time frame narrative and getting that POI selection correct. Okay, the entry model is whatever. It's the POI selection and the narrative building is what is most key. Okay, then for those of you who get a bit more experienced and advanced is what I tried to say there, but together, you do not need to necessarily limit yourself to fixed R targets in every single scenario. There are going to be times throughout the year where things are going to line up and you're just going to have a high confidence that there's good potential here for a bigger target. It's up to you whether you want to allow yourself some leeway in your trade plan to bend your rules to use technical targets. I would exercise this with caution. If you are not consistent, do not do this, okay? You need to earn the right to know when to target past your typical fixed R target. And even if you have earned the right, do you need to do it over the course of a year? No. Using fixed R targets can be a lot more easier in psychology for the majority of you, okay? Other thing you might want to play around with is how you can remove your risk. Some of you may want to trail to break even. Some of you may want to take partials. But again, it complicates things. I would keep it very, very simple and just stick with set and forget fixed R as for the majority of you until you get consistency. But this is an option if you want to consider it. Of course, trading multiple pairs. That's going to increase the profit potential. It's going to, again, potential with an asterisk there, potential. It's going to increase the trade frequency. But again, it increases the amount of risk that you can potentially be taking in the market because there's going to be even more opportunity. There's going to be more work, more analysis, more markups, more journaling. So, you're going to have to make that decision for yourself. And obviously trading, multiple EMs if you want to trade both LC1 and LC2A, if you want to trade the previous LQEMs, some of you may want to trade risk entries, some of you may have other entry models, okay? But I would say less is more, quantity over quality. We want to have the ability to have high trade frequency, so we can capitalize on market moves, but the key is knowing what moves you want to be in, not just hitting every entry model that sets up. I know I'm repeating myself, but I have to do it because there's so many of you, until you get that experience, until you've been burnt, you won't really take heed of this advice, okay? Now, these are specific, these two ones at the end for this LC1 entry model. I spoke about it briefly in the very first lesson of the module, I believe, but obviously I'm using lower time frame lid. I think a really good filter, especially at the start, that could help you reduce the number of potential trading opportunities is to only use medium time frame lid, okay? I think that could be a really good filter for when you're starting out. I haven't actually collected the data. I wish I had now to kind of filter to go in and see what the difference in stats would be. But yeah, I think that's a really, really solid one that you can consider using as a rule. And another rule you may want to add in addition, or maybe you just want to use one or the other, whatever, is that the lid must be within the medium time frame POI. Okay, so that kind of is another way of solving the problem of asking yourself, is the lid too far away? Is it too low down a leg? Is it relevant? This could be a rule that may help you to be a little bit more mechanical and in theory improve the strike rate because you're using that lid right within the medium time frame POI. Okay, so that's definitely something to consider that I would push you guys towards if you're struggling with this entry model and if you're finding it, you know, a little bit too hard to know when and when not to hit it. Okay, so yeah, I'm excited for you guys now. You've got both of these really, really powerful and effective entry models in your hand, but proceed with caution. Make sure that you're just not hitting every trade, as I keep saying. Build the experience, but I'm very high confidence that if you put in the work, 3 months, 6 months, 12 months, however long it takes, you can be in an extremely good position to have good results in the long run. So yeah, hope you guys took some value from that. Hope you've taken some inspiration for the work that is required. Enjoy it, enjoy the process. And yeah, don't be afraid to share your testing results in the Discord channel to inspire others. Cheers, guys.